Hi, Abby. How are you?
Good, Kyle. We are live. I'm going to start in just a minute. So if you want to click off your camera, we'll see you for your talk. Good morning, everyone. We're going to start in just 30 seconds. Okay. Welcome, everyone, and good morning. Good morning to our presenters and to all of you joining us. I'm delighted to welcome you to the inaugural Fall Research Conference of the Opportunity and Inclusive Growth Institute at the Minneapolis Fed. For some of you, the word inaugural might raise questions. The Institute has hosted conferences before. Some of them were in the fall. They presented research. What is inaugural about today's event? Well, today's event has two purposes that are new to our conference offerings. First, we are bringing together a growing broad research community supported by the Institute. This community is united by work on how to achieve full opportunity and inclusion in our economy. And the Institute is its bridge to the Fed. So with today's event, we are creating a home for this community to come together periodically. Second, we are showcasing the range of frontier-style research that the Institute supports and engages with. This range encompasses a variety of methods and topics. Why so broad? Well, to paraphrase a commercial, it's in our name. Pursuing actionable research on how to guarantee opportunity and enhance inclusive growth means looking at a range of problems from many perspectives and using all available tools. And why an emphasis on frontier-style research? Over many decades, and born of hard lessons, the Federal Reserve has developed research units to inform our policymaking using the very latest approaches. The Institute follows in this tradition, but expands it to better contribute to the full employment piece of the Fed's mandate. We aim to gather expertise on the great diversity of experiences across workers, families, and communities that make up the US economy. Over the course of today's presentations, you will get to see that approach in action. But we are not satisfied with working only with today's established scholars, great as they are. We are working hard at the Institute to support the work and development of the next generation of researchers. To this end, we held a full-day mentoring workshop to hone projects by 7 younger scholars yesterday. These scholars and their projects are listed on the website for today's event, and I hope you'll seek out their work as it becomes publicly available. Now that we understand why we're here, let me briefly summarize what we'll see today. Our paper presentations are organized into 3 thematic blocks. These are monetary policy and inequality, income volatility, and discrimination and remedies. Each block contains 2 papers. Authors will have 20 minutes to present their paper, followed by 10 minutes of discussion comments, and then 10 minutes of Q&A from the audience. Please submit your questions through the Q&A feature. Don't be shy. Q&A is visible to our conference team, and our moderators will be following it throughout the event, and they want to hear from you. They are eager to see your questions and will pose them to our presenters after each discussion as time allows. If you'd like to be identified, please include your name and affiliation in your question, and the moderators will share that. Before we begin, let me highlight our keynote panel discussion coming up at 11:30 Central Time. The panel, Race in Economic Research from One Dimension to Many, grew out of the Institute's work with the wider Federal Reserve's Racism and the Economy series this year. One part of that series focused on the economics profession, and as the report the Institute released following that event shows, a major recommendation from that event is that economics needs to make substantial changes to the way it studies disparities across race and ethnic groups. I encourage you to revisit that report and that event. In today's keynote panel, we will continue the discussion of how exactly we should do this. I'm so grateful to our panel for contributing on this question, and I look forward to hearing them later. The reason this ongoing conversation is so important is ably laid out in a brief that we've released today alongside this event called Where Do We Go From Here? This brief gives voice to 4 scholars of color who are just beginning their careers in economics and outlines their views on where economics has made progress and where more is needed. Our panel will touch on this if time allows, and I encourage you to read it. And if you'd like to keep up with our work regularly, sign up for our free print publication for all and our email updates. Our team will provide links to these resources in the chat. Finally, we will turn to President Neil Kashkari, President of the Minneapolis Federal Reserve Bank, at the end of our day, 3:30 Central Time, for brief concluding remarks. I know Neil will save the hardest questions for the end. I hope it's clear by now how much thought and work went into preparing both yesterday's and today's events. We've benefited from an outstanding program committee, many of whom are helping to host today, as well as our excellent conference staff, who have learned so many new digital tricks in the last 18 months. I can't name all of you, but I see all of you and I thank you. To our audience, thank you again for joining us. We hope you'll look for the same event next year when we plan to host it in person. But if you've become a fan of the access and freedom virtual conferences provide, don't worry. Our current plan, tentative as they all are these days, is to host this virtually in alternating years. And now I'll turn to our first presenter in our first paper panel, Moritz Kuhn.
Okay, so thank you very much, Abby, for this great opportunity to be part of this conference and to present some of my recent work, that is joint work with Alina Barcha, Murat Jularik, and Paul Wachtel. And I should say that 2 of my co-authors are actually working for the Fed in Denmark and for the New York Fed. So these are our own views and they do not represent any views of the respective national banks. So what we want to do in this project is to talk about and think about monetary policy and racial inequality. What motivates this work? So today, 150 years actually after the end of slavery, we see in the United States still very large racial gaps, both in income and in wealth. If we look at 2019, the latest year for which we have data available, and look at the median white household and the median black household and compare their wealth, we find that for each dollar of wealth that a white household owns, a black household only owns 11 cents. So this is almost a ratio of 1 to 10. If we look at the same statistic for income, the gap is smaller, but it's still large. That's for $1 of income that a white household earns, we find that a black household at the median makes 58 cents. These differences, although they are well known, they are very persistent, have traditionally been outside of the focus of macroeconomists and monetary policy makers, largely. So recently, we have seen more and more research, and I'm sure we are going to talk also more about this today, that thinks about the distributional consequences of monetary policy. And that's also how we see our paper fit into the literature. Namely, what we aim for is for a better understanding of how monetary policy impacts one particular dimension of inequality, namely racial inequality of wealth and income. So how we want to proceed is to do this in 3 steps. First, we want to just describe the different financial situations of Black and white households today. And if I talk about today, I always refer to 2019, which is the latest year from the Survey of Consumer Finances on which we are going to rely for this analysis. Then in the second step, we take a standard approach from the literature to estimate the effect of monetary policy on unemployment and asset prices. So we always want to look at like what happens to income and what happens to asset prices after monetary policy shocks. And then we combine what we have documented in the first step about income and wealth differences, combine it with what happens to asset prices and what happens in the labor market to unemployment differences between Black and white households to then derive an estimate of how much do differences in income and how much do differences in wealth change after monetary policy shocks. What do we find, just to give you an overview before I walk you through the different steps of our analysis. In the first step, we just corroborate findings from the literature that monetary policy shocks lead to persistent effects of asset prices. So this is something that we probably want to take into account when we think about monetary policy, or about the distribution consequences. Then if we look at an accommodative monetary policy shock, we find, and that has also been argued and it's also very prominent in the policy debate, that the racial unemployment gap closes. Okay, so the unemployment rate for Black households goes down more than for white households after a reduction in interest rates. But on the other hand, we also find large differences in capital gains from differences in portfolio composition in combination with very different wealth levels of Black and white households. And if we then, and that's going to be the last part of my analysis, combine the asset-induced wealth gains with the earnings gains from a closing of the unemployment gap, we find that the wealth gains are larger by orders of magnitude compared to the earnings gap. And that is because most of the asset-induced wealth price gains actually fall on white households. So what do we conclude from this? That at business cycle frequency, monetary policy seems to face a trade-off between racial wealth and racial income inequality. Okay, that's going to be the key conclusion from our analysis. In terms of data, just to give you an overview, we are using the data from the Survey of Consumer Finances, which I think by now is still, or has been established as a primary source to study income and wealth inequality in the United States, in particular because of its particular sampling scheme that allows it to also cover the richest households in the US economy that are typically very hard to analyze based on standard surveys. If I'm now going to talk about wealth, you should always think about the sum of marketable assets minus debt. Why do I say marketable? Because there's no social security wealth and no defined benefit plans in there. But it's still like the standard measure of wealth in the literature. If we then look at earnings, that's going to be just your labor market income, so the sum of wage and salary income. As asset prices are going to play an important role, what we want to do is to look at like all stock holdings and all bond holdings of households. So if you hold some of your stocks in a retirement account, we actually distribute them to your stock holdings. So we have direct and indirect stock holdings and bond holdings. For the unemployment gap, we are going to just use standard data from the Bureau of Labor Statistics. Okay, so here first description about the racial differences in income and wealth. So just to explain this table, you have here always the means, okay, so average differences and the median. And then you have the first column are white households and the second column are Black households in 2019. This last part here, it's also important to look at. This is like the answer to the question, like how many of the households actually have some assets of that category. So if you see here 75 for white households, that means 75% of white households have housing, whereas it's only 46% of black households. If you now look at this table, I'm not going to go through all the numbers, but you see that in particular with respect to financial assets, there are huge differences between black and white households. And you see, if we look at the median, that there's a lot of zeros for black households. Okay, that means that if house prices go up, if stock prices go up, that means that over 50% of black households are not going to benefit from that because they don't own any of these assets. Okay. So now let's look at the portfolio composition of households. And here I show again on the left-hand side, white households, on the right-hand side, black households. And this is always as a share of total assets. So if you look at white households, about 45% of their total wealth is invested in housing, whereas it's slightly over 30% for black households. So we have about a third more housing assets in a white household portfolio. If you compare stocks, there the relative difference is even larger. You have a twice as large equity share compared to black households. Okay, and these differences are going to play a key role later on, because they are going to drive most of the asset price induced capital gains if we look later on at the consequences for wealth inequality. Okay, so what's now the plan for our estimation of the gains? So in the first step, and I'm just going to show you results. I'm not going to walk through the technicalities. You find them all in the paper. We estimate the effects of monetary policy shocks on racial unemployment gaps. This is going to be our measure, what is going to happen on the labor market, on the earnings side. And then we are also going to look at what monetary policy shocks do to asset prices. And we do this using some methods that Moritz Schularik, Jorda and Taylor have used in the past, or like it goes actually back to the work of Stock and Watson. Okay, so that's just for the technicalities. For the second step, we then take these estimates from the effects of monetary policy shocks and combine them with what I just showed you about the portfolio composition of households. Okay, so now we look at like how much stocks do you hold, how much do stock prices change, and that gives us an effect, and that's what I'm emphasizing here, first order approximation of wealth changes from monetary policy. For unemployment, we do something similar. We look at like how much do employed households earn, how much do unemployed households gain. Now now there is a closing of the unemployment gap, so more people are employed, so we can get an estimate about the earnings effect from a closing racial unemployment gap. Okay, so that's going to be our second step. And now we want to bring these two together and ask, okay, there's a wealth effect, there's an earnings effect. Let's try to compare orders of magnitude, and that's going to be what we do in the third step. Then we are going to relate these changes to income to make them comparable. And then we are going to see how much is the earnings effect and how much is the wealth effect from monetary policy along racial lines. Okay, so here, this is one piece of results from our paper where we estimate the effects of monetary policy shocks on asset prices. Okay, so we look here at the stock market. You see on the horizontal axis, this is time in month. On the vertical axis, it's just percent changes of the stock price. And you see here that for the stock price, after 60 months or after 5 years, we see a persistent increase of stock prices. Here in this case, I should say, we look at a 100 basis point monetary easing, and the underlying monetary policy shocks that we're using are Roma and Roma. In the paper, we are also using other estimates for monetary policy shocks, and results are very robust. Okay, so these are stock prices. Now look at house prices. Again, we find a very persistent effect that peaks after about 3 years. Then it recovers a little bit, but it's at least the point estimates remain positive, although the 90% confidence band show that it's no longer significant. If we look at the treasury yield, we see declining and then recovery. Okay, then I told you we also look at the labor market, at the unemployment gap. So this is the difference between the unemployment rate of black households and white households. And what we see is numbers are negative. So the unemployment gap closes after a reduction in interest rates. Okay, and you see there's a very persistent effect, but it's relatively small. It's like 30 basis point, the reduction of the unemployment gap. Okay, and later on we are going to translate this change in the unemployment gap into an earnings effect. Okay, so now what we want to do is to combine these estimates that I've just shown you with the portfolios that you observe for the different for black and white households. We have to somehow deal with, like, how do you translate these change on the treasury yield in effects on bond prices. Let me not go into the details because we describe this in very much detail in the paper, and the effects quantitatively are just so small that given the time that I have, I'm going to not use my time in the best way. Regarding assumptions, there are obviously underlying assumptions for what we do here. Just to tell you two important ones. First of all, we assume that there's identical price changes within asset classes. So it's not that white households might have invested in different stock than black households, and therefore we see differences in how much the stock position is going to revalue. So we assume identical changes here. And I'm also going to show you some effects on interest rates and interest income. There we assume that there's full pass-through, that first of all, there's a direct effect on, like, how much you make on your bank account. And secondly, we also assume, and that's probably the even stronger assumption, that everyone after our reduction in interest rate refinances and then gains from lower mortgage interest rates. Okay, so this is first the revaluation of the asset positions. And I show you here in the left panel, I show you the average household. And again, on the right side, I show you the median. Okay, and for median, to approximate this, we just take houses between the 40th and the 60th percentile of the wealth distribution of black households and white households separately. Okay, so what do you see? There are huge gains. Okay, so here you have always year 1, year 2, year 3, year 5, year 4, year 5, and you have gains for white households, gain for black households, and you see white households gain always much more. Okay, there's one effect that comes from just having more wealth, but there's a second effect also coming from a different portfolio composition between black and white households. Okay, and you see here that the largest part of the effect actually comes from equity. And I told you the bond effect is very, very small, and then there is a substantial housing effect here too. Okay, so now let's look at the median. We see more or less the same pattern. Much higher capital gains for white households compared to black households, with a peak in year 3. But there's one important difference. If you look at the median, the largest effect actually comes from houses, whereas for the mean, the largest effect comes from equity that is held at the very top of the wealth distribution. And this top of the wealth distribution is almost completely populated by white households. Okay, then we are also looking at effect on interest rates. Okay, here again we have the mean, we have the median, same definition as before, and there are now two effects. There's one good effect for households. If interest rates go down, you have to pay less on your mortgage. If interest rates go down, you make less on your bank account, okay, or on bonds that you. Okay, so you see here for the average white households, the net effect is actually negative. Okay, so the interest rate effect for white households is negative. It's roughly $200 per year. That's what we estimate using the effects after 1 year. And then for black households, we see a slightly positive effect here. If we look at the median, we actually find that the net effect for black and white households is positive, just because there's not such a large negative effect from interest on savings. Okay, so now what we still have to do is, that was like the financial side. Now let's look at the labor market side. We have to come up with an estimate about how much does this change in the unemployment gap translate into changes in earnings. Okay, how do we do this? So now we go again to the Survey of Consumer Finances. and look at the difference between income, earnings of Black households if employed, and earnings of Black households if unemployed. So this is what we say, if you become employed, this is your earnings scale. This is to a certain extent a heroic assumption, because it says everyone who finds a job makes as much as the average of people who are already employed. Okay, so if anything, you should think about this as an upper bound estimate of the earnings effect. And then we just multiply this by the additional reduction of unemployment rates for Black households. Okay, so this is how much do Black households gain more than white households from monetary policy. Okay, and in the survey of consumer finances, we have information about, like, has the head of household been unemployed in the last year? And we also have information about the income of the household in the last year. Okay, so now we take these estimates. For Black household, that's on average like $56,000. If unemployed, that's $27,000. So the difference is about $29,000. So this is this difference here. We multiply this by our earnings, by our unemployment gap estimate. If we do this, what we find is $79. Okay, so Black households gain more. This is only the additional effect. Okay, unemployment rates go down for everybody, but there's an additional effect for Black households, and that accounts annually for 79. This is at the peak of the effect after year 3, $79 or 0.2% of annual income. Okay, so now last step, we want to compare these effects. Okay, one thing that we have to be aware of, the revaluation effect of assets, that's a one-time thing. Okay, you revalue your stock market portfolio. Whereas the effect on earnings, that's something you accumulate. You earn more this year, you earn more the next year, you earn more the year after. So we are accumulating the earnings effect over time. And this is what you should be seeing here, but it's like so small that it's hardly visible, at least compared to this very large revaluation effect of capital gains. Okay, and this is one of the key results that I put up on my results slide. So there's like 2 orders of magnitude difference between the revaluation effect from asset price changes and the earnings gains. I should make clear, so we always show them as both being positive, but those effects are positive for white households and those effects are positive for Black households. Okay, but you see that the gains are very, very different in terms of orders of magnitude. Final point in my last 30 seconds, you might say, well, this is only a revaluation, but how does this translate in consumption? Okay, so now we take some recent estimates about, like, how much do people actually consume out of this revaluation effect? Okay, and there are recent estimates for the stock market, and that is probably pretty representative given that we have most of the effects here coming from equity. And this is 3 cents out of the dollar. So if your stock market portfolio goes up by $1, you spend 3 cents on average on consumption. So if we take our estimate for white households, this is a consumption effect of $600. If you remember my estimate for the earnings effect, that's $79. Okay, so the one is consumption, the other is earnings. So even if we compare this, we have a 6-time difference in the effects. So although we find a better labor market situation for Black households, this might not show up as a reduction of the consumption gap between Black and white households. So let me conclude. Monetary policy shock differentially affect earnings and wealth of Black and white households. Black households gain in the labor market. They have a stronger employment growth and earnings gains. White households gain in capital markets with large capital gains on their assets. If we look at the consumption effect and use some state-of-the-art estimates for the consumption response to capital gains, it's conceivable that the earnings inequality does not reduce. And that let us conclude that there's a trade-off for monetary policymakers between reduction income differences and increasing wealth differences. And one conclusion you might draw is that the reduction of racial inequalities is important, okay, and I think we all agree on this, but that the tools that the central banks have at their disposal might not be the right ones to make a lot of progress in this direction. Thank you very much.
Thank you, Moritz. It's perfectly on time. So we have a discussion by Lenin Condon. You have 10 minutes. Could you unshare, Moritz, your screen? And now, Lenin, you can share your screen to put your discussion on the screen. Perfect. So you have 10 minutes.
All right. Can you see the screen?
Yes.
Awesome. All right. I would like to thank the organizers for putting together this awesome conference, including the day ahead. I enjoyed reading this paper, and before I continue, these are my views, not the views of the Federal Reserve System or the Minneapolis Fed or the Board of Governors. So let's jump right into it. All right. What Moritz and his co-authors do in this paper is obviously an attempt to answer a very important question, a topical one, but also one that has been around for a long time. Is there a connection between monetary policy and wealth inequality? I put shocks in parentheses because obviously, and some of the questions in Q&A hint to that, there are many ways to think about sort of the stance of monetary policy versus other things. So it's an important question, two important tools, two important items, monetary policy and wealth inequality. I think sort of this in a standard summary slide, this consistent, and Moritz said this already, but just to summarize, what they do in this paper is really 3 steps, right? So first, they document that wealth inequality is correlated with portfolio differences. So the poor and the rich don't really have the same portfolios in terms of housing, in terms of stocks, in terms of bonds. In fact, there is a large share of non-housing financial holding for the wealthiest, and we have significantly higher asset market participation among white relative to black people. So what it means in particular is what I mean by asset participation is not only on the housing market, but also on the stock market. So having documented that wealth inequality sort of correlates with portfolio differences, both within the distribution overall, even among white, but also across races, then the paper takes this standard monetary policy shocks and sort of estimates its effects on asset prices first, with an eye towards portfolio differences, but also specifically looking at the black-white unemployment gap. And then using this estimate, basically then the paper computes sort of implied wealth effect from these different portfolio mixes across the income and wealth across the wealth distribution and across racial groups. Moritz sort of walked through this slide already, but we see obviously that there's a very strong effect on stock prices. The scales are not the same on this graph, so and I think it's important to flag that because that's exactly going to be important for sort of the magnitude of the effects. The stock price effect is huge. After 3 years, we are talking about 4%. While the unemployment gap effect, the unemployment gap is larger. This is the unemployment gap effect is not so large. We're talking about 0.3 percentage points. So it's really not that big. The house prices, the effect on house prices is relatively big and not as large as stock prices. So overall, it's really a race between sort of this very strong appreciation of stock prices that's really going to affect the wealthiest, and the more modest but still relatively large appreciation of house prices, which is going to matter even for the median wealth in white households. And then in contrast, when we look contrast to the relatively modest reduction in the racial unemployment gap. And overall, we can already see how sort of expansionary shocks will tend to sort of to cause an increase in wealth inequality as a result. So why should we care about these results? Of course, we have all known that we know that the wealth distribution is concentrated at the top, and there's a vast amount of research that has been sort of dealing with that across all fields of econ. But what's also important to note is that there is a staggering and persistent racial wealth disparity, right? So what I show here is just sort of using the SCF plus from the other VKSW paper, And I'm just basically sort of computing very quickly sort of percentiles of the net wealth distribution in 1960 and in 2016. This is another way of seeing sort of one of the data points that Moritz showed, which is you can see that the 75th percentile of Black income by Black net wealth is less than the median, way much substantially lower than the median wealth for in white for white. And that ranking and those magnitudes haven't moved much over the last 4 or 5 decades. So it's important sort of therefore to ask, what is race in this paper? Because it's not a paper about, the title of the paper is Monetary Policy and Racial Wealth Inequality, not just wealth inequality. And so in this paper, basically race is 2 dimensions, is exogenous portfolio differences and portfolio differences. So to the extent that Black people are poorer, they have different they have different a different composition in terms of their portfolio. And then the added dimension of what race does or is in this paper is really sort of the differences in earnings and unemployment employment outcome. What race is not in this paper is that there's an assumption, for instance, that these valuation effects are common across all groups, whether it's wealth groups along the wealth distribution within a racial group, but also across them. The place where the effect of monetary policy shocks in relation to race is explicitly different is the relationship to labor market responses. And as the paper and the authors correctly point out, there have been some early work on this. I personally always like to sort of flag the work of Carpenter and Rogers, who I think understood very early on that this was an important question to tackle and used other methods earlier on to sort of see if the essential monetary policy shocks affect the labor market response difference across races. Now, it may be important to ask if this is necessarily the case. You know, everybody's talking about a very hot housing market right now. Is that experience similarly shared across all groups along the wealth distribution? And is that common across all racial groups? So for those who didn't come to the, so I'm gonna look at the case of housing. Housing is interesting here because even for the median wealth among whites, it's substantial, and it happens to be the one where sort of there's an important extensive margin among the Black population. So we know there are persistent racial differences in the housing market, from home ownership rate to lending terms to refinancing. It's just pervasive, redlining, and the list goes on. So, and we also know that housing, as I mentioned, housing is the main asset for median white household, while the median Black household does not own one. So let's take as given this portfolio and this complicated background, and let's look at sort of the valuation effect. So for those who didn't come yesterday, Francis Wong presented his paper in the Day Ahead conference, where he was telling us that Black homeowners have systematically lower returns on the housing they own compared to white homeowners. And going back to one of the questions I think Claudia asked in the chat, they connect that explicitly to labor market exposure to sort of labor market risk triggering distressed sales. Now, what I did is, and Francis was really nice to sort of share the data point with me. I said, well, could you share with me your data points on this housing sale return gap? So sort of the difference, when you compute the annualized return on when you sell your house, you take the white one, you take the Black one, you compare them with a bunch of fixed effects, including, so this is in the same county. Why don't you give me those estimates by year, and let me see if there's any correlation with these monetary policy surprises. And so what we see here, and it's really cursory, it's eyeball econometrics at best, but what I want to suggest with this graph is that monetary policy surprises matter for the size of the lower returns that Black households will get on when they sell their houses. And we know that this is related already to sort of labor market risk. So what this is suggesting to me is that there are 2 points here that I want to make. One is that this actually suggests that exploring the nexus of sort of the earnings channel that the paper talks about and the asset markets could be a little richer. But what it also tells me is that the asset prices effects we're getting are not necessarily common across all those groups, and that one could sort of take that on more explicitly. Now, I think one thing that I think it's important, given sort of the background of the paper, to say, well, but how far can we go with these shocks in thinking and understanding sort of racial wealth inequality? So in the spirit of the paper, in the sense that a primary driver of the result of the paper is exogenous portfolio differences, well, I'm just going to sort of take to look at another paper, just looks at sort of overall inequality in wealth and in income, and look at how various shocks have been shaping that. So this is, here I'm using work, I'm just taking this graph from Barab, Born, and Luthiker. And what I want you to see is that if you look at the solid black lines, which are showing you the fraction of the top 10%, top 10% of income and wealth in each panel, what I want you to see is that you have to squint really hard to see sort of the driver being sort of the green line, which is monetary policy. A lot of other shocks are shaping the size and the nature of inequality using these measures in the United States. Now, each one of those shocks, may they be on the fiscal side, may they be sort of shocks that tend to increase the profit margin of firms, or that tend to lower the labor market share, all those things can interact and circle back and feed back into how monetary policy responds. But it's important to sort of kind of take this view. So, okay, these are potentially the other things that are shaping overall wealth inequality. And these margins may also matter for racial wealth inequality. And so, in the interest of time and sort of to allow for a richer conversation, I just want to take stock based on those things. I really think we need more research like this. The theory and the data, and obviously sort of the history tell us that race matters for economic outcomes. I wish that sort of in this paper, the authors explicitly look on these disparities. I think the unemployment rate one is exactly one, but I think they could have gone further. And I think the example I gave with sort of the housing sale return is an example where one sees and knows that those margins matter. There have been papers on the refinancing rates and others, but I think if one wants to do this sort of calculus on sort of how the portfolio is changing, both on the intensive and extensive margin, one can sort of use more micro data and explicitly track the actual experiences over time of this household, of the households of different wealth levels and of different racial groups. And to sort of really sharpen the difference between just wealth, I would say, and race. I think perhaps the harder and more important questions for us all might be, where do these disparities really come from, and how do they vary over the business cycle?
I mean, I don't think this is going to be a problem. I mean, either they want.
And how do these, in fact, in turn, interact with the goals of monetary policy? I enjoyed reading the paper. I had multiple very important, nice conversations with my colleagues with them as well about it. So it's a very engaging paper, and thanks again for giving me the opportunity to discuss it.
Thank you very much. Let's move on to some questions that we got many good questions. So one question is from Lowell Ricketts from St. Louis Fed, and I have the same question. Do you have any idea about how this channel might be different depending on conventional and unconventional monetary policies?
So I don't. I can only conjecture that, like, if we think about unconventional monetary policy directly trying to affect asset prices, I would expect that it might be stronger, but this is only speculation. We have a little bit of the same speculation in the paper, but we have no systematic evaluation of that.
Thank you. Another question is, so I guess the big issue is how to promote the wealth accumulation among the Black households, and especially probably housing is a good a step for promoting accumulation. And is there any active role that you can think of in that regard for the monetary policy? Can you comment on that?
So yeah, I think it's also related to what Elena said. I think like one thing that we have to be aware of in this entire discussion is like the situation, like, or that we have to, the question that we have to ask ourselves is like, how did we actually get into this situation? Okay, and we have some other work where we not only look at the last 50 years, but where we really try to get estimates for the racial wealth gap going back until the end of slavery. So 150 years, that's also joint work with another fellow of the Research Institute, Laura de Renoncourt and Chi Kim, postdoc here from Bonn. And what we find there is, and that's like, I think the key point that I want to make here is, like, the situation today is still very much inherited from history. Like the situation where we are today, and also what this question was like, is this about race? Yes, it seems very much to be about race, because like the current financial situation of households is something that's still inherited from 150 years ago. And now, I think regarding your question, it's like this, and the point that also Elena made about asset market participation, I think this is a dimension that overall we still have room to study and to understand better. Why do some people not invest in certain asset classes? Okay, and then one thing that obviously comes to mind is discrimination, both in the housing market but also in the credit market. And I think that's not like, I think I'm going to repeat the last point from my conclusion slide. It's not directly obvious to me that the measures, the instruments that the Fed has to its disposal are like the best targeted instruments to address these problems. Okay, but I think obviously investment, and also I think there we maybe also have to think about things like trust in the financial system. So also some weaker factors that might play a very important role here.
Thank you. Another question is, there's a difference in the portfolio is fascinating. The question is, where is this coming from? I mean, probably part of it is coming from just the level is different, and if you're lower level of wealth, your competition differs systematically, I guess, even among the white households. And another thing is maybe the type of employment, maybe instability of the employment for typical Black households. For example, they might not be able to get the health insurance from the employers, or like a pension, subsidized pension from the employers. That might contribute to the difference in the portfolio. Can you comment on these things?
I can only say that I completely agree with you. So like as soon as we start looking at white and Black households that are like in similar positions of the wealth distribution, they also look reasonably similar. Okay, so it's like, it's very hard to study like rich Black households, because there are very few of them. And although the Survey of Consumer Finance does a great job of like surveying rich households, like it's in the top 10%, only 2% of households are Black, if I now recall the numbers correctly. So it's very hard to say anything about like, do they have different portfolios if they are very rich. But like if we look in the middle of the distribution, then it seems to be that Black households in the same financial situation seem also to make similar financial choices. That's like, I think, what we can say from the data that we have. And then I completely agree, and that's again about participation in asset markets, thinking about the defined benefit plans, the defined contribution retirement plans, access to them, job stability, and in how far can you actually accumulate wealth, or do you have to use all your savings all the time to finance periods of unemployment? If this is the case, then we should not be surprised that there's like no systematic wealth building. If all the wealth that you have, you always need to just deal with certain challenges in life.
Thank you very much. There are more questions, but I guess we are running out of time, so I'm going to move to the next paper. Thank you very much, Moritz and Eleni.
Thank you very much.
The next paper is Jim Bullard. Jim, you can share your screen. You have 20 minutes.
Thank you, and thanks to everybody for coming today. I'm looking forward to the whole conference here. I'm learning a lot already. This paper is called Classic Policy Benchmarks for Economies with Substantial Inequalities, joint work with Riccardo Di Cecchio. This is a paper within a family of papers, including the paper called Optimal Monetary Policy for the Masses. So let's go on to the next slide and the next slide. There's a lot of interest in large-scale heterogeneous agent DSGE models. So I think the key thing about these models is that you should have Gini coefficients that are not zero, that approach the US data. And a key question for a policymaker like me is, what's the role of monetary policy in such a model? And the answer in this paper is going to be, if the other policymakers are pursuing a good policy, then the role of monetary policy would be unchanged. So let's go to the next slide. So what we're going to do is construct an economy. There could be aggregate shocks, permanent and temporary idiosyncratic risk. It's going to have a very stylized and symmetric structure, not entirely realistic. And we're going to get income, wealth, and consumption equality Gini coefficients on the same scale as in observed economies. Then we're going to have 4 policymaking authorities in this paper, the kind of the 4 horsemen of this story. There will be a monetary policymaker, a fiscal policymaker, a labor market policymaker, and most controversially in this talk, the education policymaker. And then we're going to describe a competitive equilibrium in which all 4 of these act in concert, and you actually get the first best allocation of resources. Let's go to the next slide. So these policymaker roles are going to turn out to be classic. The monetary policy is going to react to the aggregate shocks and try to get the Wickselian natural real rate of interest in the economy. That would be the same thing that happens in the new Keynesian framework, which dominates the literature. The fiscal authority has to raise revenue. They can do so here with linear labor income taxes. The labor market authority is going to have to run a good unemployment insurance program, or you could think of that as a health insurance program. And then the education authority is going to, and this is the weakest, but the education authority has to minimize the variance of beginning of life human capital endowments to get the fairest education system that we can get. So the main result is that the classic policy prescriptions can achieve the first best allocation of resources in this benchmark heterogeneous agent economy. We are not saying that this is actually going on. We're saying that this is a benchmark that might be useful for this literature, and then you could add features to this economy and deviate from this benchmark and see what it is that we're doing wrong in the actual economy relative to this classical benchmark. Let's go to the next slide. So there are some surprising aspects to this. The classic policies appear, at least in very broad terms, to be similar to what goes on in OECD economies. You've got central banks meeting all the time and reacting to current developments. That's exactly what they should be doing according to this model. They're reacting to the aggregate shocks. You've got tax structure that can be set for the long run in the model that can actually be set for all time to raise the right amount of revenue to run the government. Another surprising finding is that the best combination of policies, the social optimum, does drive the consumption Gini towards zero. Everyone consumes exactly the same amount, but leaves the income and financial wealth Gini substantially positive. So some of the observed financial wealth and income inequalities due to the life cycle effects alone, according to this model. And finally, this model has a pencil and paper solution, which may make it useful for the literature going forward, despite the fact that there are 3 aggregate shocks and idiosyncratic risk. Let's go to the next slide. And the next slide. And the next slide. So this is about a life cycle economy. We've got certain symmetry assumptions here, which are going to simplify our life tremendously. The hope is that you could relax those kinds of assumptions in a more computational exercise than what we've got here. This is a quarterly model, so you come in at age 20, and we start tracking you in the model when you're already at age 20. And then you live out till we keep tracking you until age 80. That's 241 quarters, and then you exit this economy. The symmetry assumptions are listed here. It's log preferences, no discounting. We're going to endow the households at age 20 with a personal productivity profile. This profile is going to start low. You're not very productive in the first part of life. You're going to be a lot more productive in the middle of life, about 50% more productive, and then less productive at the end of life. And this all happens in a symmetric fashion. That's going to allow us our pencil and paper solution here. We've got linear production technology, so it's extremely simple on that dimension. Let's go to the next slide. So here are the preferences, as simple log preferences. There is a demand shock here. I'm not going to talk about that. Let's go to the next slide. And there's a simple linear production technology. The Q is the level of technology. The D is the demand shock. The N is the size of the labor force. The L is the labor input. That's going to turn out to be a constant in this model that helps us a lot in getting the solution. So these other factors are going to have stochastic growth rates to them, and that's what's going to cause the growth in the economy. Let's go to the next slide. This life cycle productivity profile is the E's there in this slide. You get a certain amount of productivity units. This is just handed to you as you enter the model at age 20. I've already said that they're symmetric. We're going to use a baseline profile that is a symmetric profile, and then you're going to get a scaling factor C here from a log normal distribution. So the particular profile that you might get could be a large multiple of the baseline profile, or could be much smaller than the baseline profile, but will have the same shape. So you're going to have arbitrarily rich and arbitrarily poor households in this economy. In the figures that I'll show you later, we're going to use a uniform distribution instead of a log normal distribution, but I think most of you see how this works. Let's go to the next slide. So why are we assigning this, making this productivity assignment at the beginning of the life cycle? That's a stand-in, and we can argue about it, but it's a stand-in for the human capital development that takes place before age 20 in actual economies, schooling, parenting, any job experience that you would have. We don't have any of that in this model. You'd like to add that, but we don't have any of it here. So we're just saying you get handed something randomly and trying to figure out the macroeconomics from there. Huggett, Ventura, and Yaron argue the differences in initial conditions early in the life cycle, age 23 in their paper, account for about 63% of the variance of lifetime earnings. So you can predict lifetime earnings by knowing some characteristics about people early in the life cycle. And that could include race. We don't have anything in here about that. But we're using an extreme version of this where when you come into the model, you just handed a certain life cycle profile. Let's go to the next slide. And the next slide. So here's the baseline productivity profile. It's low at the beginning and end of the life cycle and higher in the middle. That's the key feature here. This is a quarterly model. So you're 20 years old at the 0 on the left-hand side. You're 80 years old at the 240 on the right-hand side. And then different people get different productivity profiles. So that blue line gets multiplied up or down depending on which productivity profile you get from the education system at the beginning of the life cycle. So let's go, and then let's go to the next slide. Yeah, there's also idiosyncratic risk. There's unemployment in the model. It's super simple. All it means is that you show up for work, there's no job that day, and you have to go get unemployment insurance on that day. Let's go to the next slide. There's a household credit market. There's just one asset in this model. It's because the relatively young households want to borrow from the relatively middle-aged households who themselves are saving for later in the life cycle. So you should think of the asset in the model as privately issued household debt. The best analog in the real world is mortgage-backed securities, but I'm not going to get into that in this paper or in this talk. Let's go to the next slide. And there's a friction in the credit market, which is non-state contingent nominal contracting. There are two aspects to this assumption. The non-state contingent aspect means that real resources are misallocated. But the nominal aspect means that the monetary authority might be able to do something about it. And indeed, they're going to be able to fix this distortion in the economy. Let's go to the next slide. There are additional assumptions. Let's go to the next slide. And next slide. So there are four policymaking entities, and the proposed policy mix. Just go to the next one. The proposed policy mix is that the monetary policymaker follows nominal GDP targeting rules similar to Koenig and Sheedy. The fiscal authority sets a linear tax on all labor income that's sufficient to meet the revenue requirement. The labor market authority also uses a linear labor income tax to fund an unemployment insurance scheme. And the education authority does a beautiful job and minimizes the dispersion of life cycle productivity profiles by setting the dispersion parameter sigma equal to the minimum sigma min. Let's go to the next slide. And there's a theorem. If everyone does that, all the policymakers do that, then the real interest rate in this economy will be exactly equal to the stochastic output growth rate at every date. And if you had a social planner that was equal treatment to every single person in the economy for all time, going forward and backward in time, and they discount at this real rate of interest, they would conclude that this is a social optimum. So you've got a simple enough heterogeneous agent economy that you can talk about the full social optimum in this economy. Let's go to the next slide. So first, we're going to just show how the monetary policy works, and then we're going to look at some other pictures here as we go through. Let's go next. So the policymaker has to follow this price level targeting criterion. There are actually many ways to implement this criterion. I'm going to show you one picture, one implementation on the next slide. And this picture is just meant to indicate that there's nothing surprising about the way the monetary policy works. The shock would come along in the upper left panel. So something bad happens in the economy and the economy grows more slowly for a while and then comes back to normal. The interest rate falls, but not in the period of the shock, but falls later and comes back to normal. What's classic about the nominal GDP targeting is the lower right picture. Inflation goes up in the period of the shock to exactly offset the natural rate shock and make the nominal interest rate not change in the period of the shock. What you want to do here is ratify the nominal interest rate contracts that were signed in the previous period. But after that, inflation, and in this implementation, after that, inflation is below target and then comes back up to the steady state inflation rate. Let's go to the next slide. Next slide. So ours worked over the life cycle is this blue line here, and the vertical axis would be the percent of time spent working over the life cycle. The red dotted line is the economy-wide average in the US data. So people are going to work less. The cohort average is going to be much less at the beginning of the life cycle, and the cohort average is going to be much less at the end of the life cycle, but high in the middle. So the key thing about this picture is rich people like doctors and poorer people like taxi drivers all work a lot more in the middle of the life cycle because that's the time when they're most productive. So that's why that blue line's above the economy-wide average. Let's go to the next slide. The education policy then, which is the most abstract here, can influence the productivity profile dispersion parameter, sigma. So you could interpret that as some kind of idealized insurance market that operates before households enter the economy at age 20. There'd be a limiting case where the sigma min, the very lowest you could have is 0, which is what we used in the theorem. That would be a perfectly equal economy. Every single person gets handed the same productivity profile at the beginning of the life cycle. That would drive the consumption Gini all the way down to 0. Everyone would consume the same amount, but the income and wealth Ginies would remain close to observed values in the data. Well, I'll show you a picture of that. Let's go to the next slide. Let's go to the next slide. So people want to work more. They're more productive in the middle of life, but they also work more in the middle of life. So you get this picture for labor income. And just keep in mind, the vertical axis, the same number of people in each cohort. We have a continuum in each cohort in the quarterly model, thinking vertically in this picture, but the dispersion is much higher in the middle. So we're going to calculate the Gini coefficient of the blue mass here, and it's going to be close to the data. Let's go to the next slide. And then for consumption, that under the optimal monetary policy, then people are able to move consumption around during the life cycle so that they smooth consumption. That's the red box here. And we're going to calculate the Gini coefficient of the red box. Let's go to the next slide. And this is just a reminder, this is a growing economy. So what you would observe is different individuals over time in these different colors here would have different experiences. Let's go to the next slide. And this is the asset holding, the net asset holding. It's a closed economy, so this has to net out to 0. And who's holding the assets? Well, it's people on the right-hand side of this picture. They own positive net assets. The people on the left-hand side of this picture are borrowing. And the blue line is the guy that has the baseline productivity profile, and the others are multiples up or down from that. I would just point out here that if you know, helping borrowers in this economy would be helping people on the left-hand side of this picture, but there are rich borrowers and poor borrowers in this on the left-hand side of the picture. And in particular, if you had the doctors that want to borrow a lot for their big house that they're going to buy, they're on the left-hand side of this picture, and they'd be helped by interest if you wanted to lower interest rates to help borrowers. Let's go to the next slide. There are other notions of income. Next slide. Here's including some capital income on the right-hand side of the life cycle after age 120. Let's go to the next slide. Here's another way to look at total income over the life cycle. Next slide. Next slide. There are different marginal propensities to consume. They're based on life cycle effects, but I'm not going to talk about that here. Let's go to the next slide. Next slide. Next slide. So to get the in the Gini coefficients, then what we did in this table is calibrate to the consumption Gini. So we get 32% there. The model also 32%, but then the income Gini based on the second definition, 51% in the US data, turns out to be 51.1 here. And then the wealth Gini coefficient is 72 against 80 in the US data. But there's more to say on Gini coefficients. This is not really, you know, this is like a light calibration, I would say. But the point is that without doing too much work, you can get kind of big Gini coefficients. Let's go to the next slide. And I just want to spend a minute or two on this slide because I think it's, at least for me, it was instructive about what the heck is going on here. So the The sigma on the horizontal axis, that's the dispersion of these productivity profiles within a cohort. So intra-cohort productivity dispersion. And the vertical axis is the value of the Gini coefficient, somewhere between 0 and 1. 0 would be perfectly equal, 1 would be perfectly unequal. And as you take your sigma out to the right-hand side in this picture, all the Gini coefficients go to 1. So it's an absolute nightmare in terms of inequality, a perfectly unequal economy. And then if you go to more to the left there, you see the black vertical line. That's where we calibrated. We calibrated to that because then that would give us the consumption Gini of 0.32, which is the one we see in the data. And then you get a labor income Gini, the blue line of the one that was reported in the table just now. And then the wealth Gini would be about a 0.72. That was the black line, vertical line there. But you could calibrate to a higher wealth Gini in this picture by taking the yellow line, then you'd get a wealth Gini of 0.8 at the expense of missing a little bit to the high side on labor income and consumption Gini. So these are, I think it's an interesting model based on this picture and what you can do with it. Now go over all the way to the left in this picture. That takes the sigma all the way to 0. There is no intra-cohort heterogeneity, and you get the social optimum. That is actually the very best that you can do according to the theorem in this economy. And indeed, you drive the consumption Gini, that green line there goes all the way to 0. You drive the consumption Gini to 0, but the blue line does not go to 0. Income inequality does not go to 0. That's because of the life cycle effect. People are working more in the middle of the life cycle when they're more productive. So you get a 0.44 on income and a 0.65, the red line there intersecting the vertical axis, 0.65. That's the wealth Gini at the social optimum. That's also because of the life cycle effect. It's because older people are going to be accumulating more assets to prepare for retirement in this life cycle model. So I thought this was helpful in understanding what's going on in the economy. Let's go to the next slide. And the next slide. So a classic combination of policies can deliver a first best allocation of resources in this highly stylized environment where you do have substantial inequality in income, wealth, and consumption. A monetary policymaker would have to provide period by period insurance against the aggregate shocks. That's why the monetary policymaker would be adjusting all the time. Then you could have non-distortionary labor income taxes. You could have an unemployment insurance program. And the education policy can also drive the consumption Gini all the way towards 0 or towards some minimum value that you think is out there. But that would leave income and wealth Ginis at positive levels. So again, we're not saying this is actually going on in any of the OECD economies, but we think these benchmarks might be useful for understanding which policies we could alter, what features that we think are keeping us away from better outcomes for the macro economy. But you could use this benchmark economy and perturb it in interesting ways going forward. So thank you very much for the opportunity to present here.
Thank you, Jim. So the discussion is great content. You have 10 minutes. You can share your screen and start. The floor is yours.
Great. Thank you very much. You can hear me all right?
Yep.
Good. So thanks very much for the opportunity to discuss this paper, and thanks, Jim, for a really interesting presentation. So this paper is part of a research agenda that examines how to conduct macroeconomic policies, in particular stabilization policies, in the presence of substantial inequality. So just for those in the audience who are not familiar with sort of frontier macro modeling, for a long time, the set of models that macroeconomists use to think about the conduct of stabilization policy were what are known as representative agent models, meaning that all the majority of differences or diversity in economic outcomes across households was assumed away. And more recently, there's been a shift towards what are known as heterogeneous agent or heterogeneous household models, in which some of those differences in economic outcomes and economic possibilities across households are incorporated. So this paper is squarely in that camp. It's an area that I'm deeply interested in and enthusiastic about. So I approached this task of discussing these papers with a lot of excitement. I quickly realized when reading this paper that to understand what the authors are trying to do here and where they're coming from, I had to kind of look at a different paper, which is the paper where this model is introduced, which is actually the paper I was originally asked to read, called Optimal Monetary Policy for the Masses. And so I'd spent some time digging into that paper, and that quickly sent me down a rabbit hole in order to understand what the game is there. I had to read a whole bunch of other papers as well, and learned a lot about things like non-state contingent nominal contracts, nominal GDP targeting, and some really interesting insights into thinking about redistribution and monetary policy. So this is like a literature that deals with these issues, and you should think about this current paper as kind of building off that. So I thought that rather than discussing some of the details of the specific model that Jim presented, and I have some comments on that, I have some nerdy stuff, and I'm happy to talk with the authors maybe offline. I thought rather what I do is that I would maybe relay some big picture thoughts about what this whole literature is trying to do, and maybe try and explain what the big picture is and what the message is for some people who are maybe not so familiar with it. So let me outline what I think the basic structure of the problem that this exercise is dealing with. So in all of these models, including the one that Jim was presenting today, these are essentially economies in which output is exogenous. So the total output in the economy, assumptions are made such that output's exogenous. So but output fluctuates over time. Okay, prices in the economy are flexible. So unlike in a lot of the models that are used to think about monetary policy, which deliver nominal non-neutrality or a role for monetary policy through sticky prices, this is a model in which these are models in which prices are flexible, and the price level is essentially a policy instrument that's chosen by the central bank, or if not chosen directly, its assumptions are made such that we can think about the central bank just choosing the price level. Okay, the model has heterogeneity. There's differences in households. The most important form of heterogeneity are that there are some households who are borrowing and some households who are lending, and these households can have different income. Now, against this backdrop, with this heterogeneity of households in whether they're borrowing or lending and with different income, there's a very limited set of assets that households can trade. And they're what the authors and this general set of research calls non-state contingent nominal contracts. So what's a non-state contingent nominal contract? It's any sort of arrangement between a borrower and a lender or an asset in which some of the payments that need to be made are fixed in advance in nominal terms. So the payments specify that when we come into some period, there are some nominal amounts and dollar amounts of money that have to be transferred one way or the other. I think what they're trying to get at here, which I think is right, is that we should think the most common form of this is going to be a fixed rate mortgage. So with a fixed rate mortgage, I've committed to my lender that I'm going to pay a fixed nominal amount of money every period, and that's already fixed today going out into the future. But it also captures things like corporate bonds in which coupon payments are fixed in nominal terms and other types of lending. Now, when you have a non-state contingent nominal contract like that, changes in the price level generate redistribution. So what's the idea? Very, very simple. If there's inflation, if price level goes up, that's effectively a real redistribution away from borrowers to lenders. The lenders have pre-committed to pay a certain amount in nominal terms. If there's inflation, the value of those nominal payments goes down in real terms. So those lenders are now better off, and the borrowers are worse off because they're receiving a lower real payment than they might previously have expected. The classic idea dates all the way back, even further back than than papers that I'm familiar with, Fisher and beyond. But that's the basic force that's going to be going on in the model. Now, the game here is there's going to be a central bank, and what they have to do is, against the backdrop of this exogenous output that's moving around, they have to choose the price level. So effectively, what the central bank does is choose the price level as a function of output. Okay, and it's important to bear in mind that output is exogenous here. So the monetary authority, they can't affect the level of output or the level of say, labor incomes of any individuals in the economy. So what's their objective? Why do they want to? What's going to govern this choice of this relationship between the price level and output? Well, it's going to be redistribution. So the central bank will care about the price level because of redistribution. And what I read this literature is doing is trying to understand conditions under which the central bank basically wants to raise prices when output falls. So that when the optimal policy function, choose the price level of function of output, has the feature that its derivative with respect to output is negative. Output up, price level down. What's the intuition? The intuition, well, if a fall in output disproportionately tends to fall on borrowers, then by raising the price level, those borrowers who have been hurt can be partially compensated because of the redistribution effect that I've just described. So what the central bank does is, by moving the price level, they generate some insurance for those parts of the population who are hurt by falls in output. What is nominal GDP targeting? Nominal GDP targeting is a very specific, strong form of this type of policy. In fact, what it says is that not just under nominal GDP targeting, not just is there a negative relationship between the output and the price level, but the elasticity of the output with respect to the price level is exactly equal to this particular number, -1, which it turns out is equivalent to saying that it's optimal for the central bank to set the product of prices and output equal to a constant. What's that? And that's called nominal GDP. So nominal GDP targeting says, try and set nominal GDP equal to a constant, which is a particular way of achieving this type of redistribution, which is what the goal of monetary policy is in this environment. Okay, so that's like the simplest model. And then the way that I see these, like that big set of papers that I described, is that there's a natural question, and it's natural to ask, and Jim and his co-authors did this, is, well, that's the motive. How general is that? How much does it depend on this very, very simple environment that I just laid out? So what we saw was a series of papers that then add successively more degrees of realistic heterogeneity. And what they try and understand is to show conditions under which, even in these environments that have more heterogeneity and more inequality, that looks more like the real world and more realistic features, are there still conditions under which this nominal GDP targeting can implement the optimal allocations and describe the optimal thing for monetary policy to do? So, going back, so Koenig was sort of the first model that did this. I'm drawing a lot from a paper by Sheedy, who extends it even further. He adds some sticky prices and New Keynesian elements and shows that there's still a force like this, even if you add some New Keynesian elements. And then there's a series of papers that Jim's been really instrumental in, which is adding first overlapping generations, so that it has now a reason why some households are borrowing and lending. They're basically saving for retirement. Adding in multiple cohorts. They then add in heterogeneous labor supplies, so some households work more than others. They then add intra-cohort heterogeneity, which was the paper where the basic model that this paper is built on. And then in today's paper, they add all sorts of other types of inequality and reasons why there might be inequality. Okay. So what do they find? Well, my reading of this large set of papers, including today's one, is that there's some lessons. So the first lesson is this result that we're after, that the nominal GDP targeting can implement optimal allocations and the central bank should play this insurance role, goes through whenever there are sufficient other policy instruments or markets that can deal with all the other dimensions of uninsured heterogeneity and risk. Okay, so if we have enough richness in what all the other policies are doing, or other types of asset markets that can undo them, then what will be left over is just this basic force that I've described, and hence monetary policy should still follow this nominal GDP targeting type rule. So that's the first rule, first requirement. The second requirement, of course, is that there's no other goals for monetary policy on the table. There's nothing else that monetary policy can do. So, for example, it's important that monetary policy doesn't have a role to play in stabilizing the level of aggregate output, because that would now give another dimension for what monetary policy could do. Okay, so that's when the result goes through. I think it's also important to understand is what would you need to do to break this result? And here I'm sort of drawing on some interesting comments by Adrian Auclair and Yvonne Werning, which is, it's actually pretty easy to break this result, even in the very simple model that I showed you. So one way to break it is if there's so-called heterogeneous exposure to aggregate risk, meaning that when there's a recession, the borrowers and the lenders are disproportionately exposed, their labor incomes are disproportionately exposed to those movements in overall income. The nominal GDP targeting outcome is inherently tied to the relationship between these different types of houses' exposure to the aggregate. And then the other thing that it really will undo this result is an area of heterogeneous agent models that I've been quite involved in, which is when there is uninsured idiosyncratic risk. So when some of those policies that Jim was talking about in the paper he presented, when they're not being done perfectly, so that there is still remaining idiosyncratic uncertainty and risk in households' income, even independent of aggregate risk. Okay, so that's how I see this, the main lessons. And so rather, let me finish now with some really big picture thoughts on the agenda. So that's what I see them trying to do. So there's some things that I really like about this research agenda, and I think is really to be commended. So the first is I really love the focus on exploring mechanisms for non-neutrality, why the central bank through its standard types of policies can influence welfare and real outcomes more generally than that, is beyond sticky prices. So this non-state contingent nominal contracting friction, I think, is really key. If I personally had to think about what's the most direct way in which I'm influenced, my outcomes in my life are influenced by inflation, it's the fact that I have I have a mortgage, which is a really big non-state contingent nominal contract, and that's beyond sticky prices. That's probably the most direct effect of inflation on my own welfare. So that kind of feels really important, and there hasn't been enough work like that done in the macro literature. The second thing that's really to be commended is to focus on the redistributive aspects of monetary policy rather than the aggregate stabilization. That's a direction that is for another discussion, but I think I think everyone here understands that that's an area in which monetary policy is moved, and building models that can help us understand that is really to be commended. There's some things that are troubling about this agenda, and I think it's important to just put them out. These are not criticisms, just things that I think maybe make one kind of step back and think, maybe we want to think about kind of relaxing some of these. So the first obvious issue is that output is exogenous. In fact, even individual incomes, labor incomes at least, are exogenous. And that's, to me, sort of interesting. If we really believed that, if we really thought that output was exogenous and individual incomes were exogenous, and there's nothing that anyone, even the Fed, could do about that, it's not clear that what the Fed's mandate would look like. It's not clear that the sort of redistribution that's being proposed inside these models is consistent with existing mandates. So I find that sort of troubling. The second thing I find troubling is that these are all models in which the price level is a choice. And I think from the central banking community, there's a little bit of hubris here, in that, for me, the biggest, most important questions over the last 10 years about monetary policy is all about the transmissions of instruments to outcomes, in particular inflation. And just assuming that we can just choose the price level, I think, is really sweeping under the table really the most important parts, which is what are the instruments we have and how and through what channels do those instruments actually influence the price level. Thirdly, the price level has other effects on the economy in addition to the redistribution channel that we've talked about. And I think if you want to make a case for a particular policy stance, it's important to at least give those other effects a chance to overwhelm the redistribution motive. So the paper by Sheedy is a really good one there because it adds in some new Keynesian aspects, but it's hard to kind of draw conclusions for what we should do with our price level instrument if there's nothing else that you can do with it. Fourth, I think it goes without saying, I think everyone here would agree that there's better instruments to achieve redistribution. Even we think this is the only friction that's left and the only thing for monetary policy to do, there's better instrument to do it. In fact, Jim told us that the best instrument in that paper was an assumed policy that the so-called education policy, which basically just means that through some unspecified channels, some policymaker has the ability to lower the variance of beginning of life human capital. That's even in this model, that's a better instrument. Presumably we have instruments out there that we should be focusing to try and achieve that. The friction itself, well, the non-state contingent nominal contracting friction, there are other ways to deal with that friction, even some ways that I think that are within the scope of current monetary policy, or at least actions that I see the Fed taking. For example, if the basic issue is that we can't write index debt, well, then we can encourage index debt, underwriting index debt, getting involved in the market for index. If the issue is that there's not enough indexed assets, then that's something that the Fed really can be involved in. And then finally, this is sort of like, I'll end off with one sort of maybe technical kind of point, maybe a little nerdy, is that if we're living in a model in which there's only one asset and that asset has this non-state contingent nominal friction, meaning that when I purchase that asset, I know that inflation is going to generate changes in how much the real value of my payments in the future, then both the borrowers and the lenders in this economy, they understand that. So inflation in this model is risky. And so therefore it should command a risk premium, and the risk premium on inflation should be incorporated into the price of those nominal contracts. But I didn't see that anywhere in the model. And that's maybe something we can talk about afterwards, but there's a lot, all assets out there that have exposures to things that the Fed is doing and things that happen in the aggregate outcomes. They command, those things show up in the prices of those contracts. And I don't see why this should be any different. So I'll stop there because I know I covered a lot of ground, but thank you very much for giving me the opportunity to read a really interesting literature and a really thought-provoking set of papers.
Thank you very much, Jim and Greg, for a fantastic presentation discussion. We want to keep talking about this paper, but in order to stay on schedule, let's finish this first block of this conference and take a few minutes break. And when we come back, Alessandro Foglio of Minneapolis Fed is going to open up the next block, which is a keynote panel. So let's take a short break and let's come back. Thank you very much.
Hello, everyone. Can you hear me? Welcome back. Welcome to our keynote panel today. It is my honor to introduce our distinguished panel. The title of the panel is "A Race in Economic Research from One Dimension to Many." And we will explore the structural origins of racial disparities. 18 months ago, George Floyd was killed here in Minneapolis, and yesterday will have been his 48th birthday. Since then, the world has changed. Our beliefs about what it means to be Black in our society have changed, and we started deeply questioning the extent and the origins of the vast racial disparities we observe all around us. To address this question, last year, the entire Federal Reserve System, all 12 of our Federal Reserve banks, launched an initiative called the Racism and the Economy series to examine structural racism, the impact of racism in different aspects of life, and ways to dismantle it. Those events showed how much the color of our skin can affect all aspects of our lives. The opportunities of accumulating assets, of owning a house, of finding a job, as well as access to basic health care and the outcome of an encounter with the police. The last event of the series was hosted here in Minneapolis and explored racism in the econ profession. It was an important moment in which we started questioning ourselves, our own role as economists and as scholars in perpetrating racism and disparities. We realize we have a lot of work to do. Our field lacks diversity and for the most part is abstracted from the issue of race. We know that race largely affects economic outcomes, yet research methods in economics often abstract from this complexity. We have often treated race as an unexplained residual or as the result of taste or statistical discrimination. These approaches have proven unsatisfactory and even concerning, since the way we model race has important consequences for policy recommendation. That is why we're here today. The objective of the panel is to broaden and deepen our understanding of race. We have an impressive panel of scholars today with diverse backgrounds, but who share a deep knowledge of these issues, and we're eager to learn from them. Their lessons will improve the way we design policies to address the structural racism. Our first panelist today is Belinda Archbone, Assistant Professor of Econ at Barnard College, Columbia University. Her research includes the development economics, political economy, economic history. She investigates the role of historical institutions and environment in affecting inequality. Our second panelist is Sandy Darity, Professor of Public Policy, African and African American Studies and Economics at Duke. His research focuses on inequality by race, class, and ethnicity. His current focus on stratification economics provides a general theory of intergroup inequality that combines elements from different disciplines, from sociology to economics to anthropology. Our third guest is Chad Jones, Professor of Economics at Stanford. His research investigates theoretical and empirical the fundamental resources of growth and the reasons underlying the enormous differences in living standards across countries. He has used his expertise to study how race and gender contribute to economic growth. Our fourth guest is Mario Small, PhD Professor of Sociology at Harvard University. He has published award-winning articles and books on urban inequality, personal networks, and the relationship between qualitative and quantitative methods. In his research, he suggests that in many instances, discrimination is not an individual decision, but an institutional constraint. Moderating will be Janice Eberly, Professor of Finance at Northwestern University. Not only is Jen one of the most accomplished macroeconomists, but also has extensive experience in policymaking, as she has served as the Assistant Secretary for Economic Policy at the US Treasury from 2011 to 2013. Jen, the screen is yours.
Thank you, Alessandra, and thank you to the Minneapolis Fed and the Opportunity and Inclusive Growth Institute for bringing us all together today, and the organizers who've gathered this panel. In our initial conversations, we started off with fascinating discussions on this important topic, and the title of the panel is Race and Economic Research from One Dimension to Many. And the group will talk along both of those dimensions, that is thinking both about their own research, and will present that to us today, but also exploring the themes about economic research and methodology that have been raised throughout the conference. So we'll start today with each of the panelists giving a short presentation on their own work, their view on the themes of the gathering today. If you have questions, you can put them into the Q&A, and we'll address them either as we go or at the end, depending on the way that the conversation goes. So we'd like to keep this engaging and as spontaneous as we can on Zoom. And we'll start with Belinda's presentation.
Thank you very much, Jana and Alessandro and everyone for inviting me. Let me share my slides very quickly. I said I have 3 minutes. I will talk quickly in the style of economics. So hopefully everybody can see this. Let's make this full screen so we can see it better. All right, visible. Okay, great. So, you know, as Alessandra mentioned, I am at Barnard College. I'm an assistant professor at Columbia University, and a lot of my work is in economic history is to do with thinking about how historical institutions kind of either exacerbate or mitigate a kind of long-run outcomes in terms of development of human capital, right? So in thinking about this question about, you know, what is the role of race in economics research? I'm going to make 3 main points to start out with, because this is something that I've been thinking about with a number of actually excellent scholars. We spent the last few days thinking about this at the New School. And I'm going to add power into this, because this is a conversation that I think is underlying here, but doesn't, you know, often get explicitly stated. So I'm going to make 3 points. So thinking about race, power, and the kind of politics of economics research, right? So one, this is something that maybe we all realize, but we don't explicitly state often. So just to explicitly state this, often economics research and the questions we ask very much reflect and reinforce oftentimes the kind of existing power relations in society, right? And this informs the kind of questions that we ask, it informs the methods that we use, and it informs the conclusions that we reach as well. And of course, then this has very, very real world consequences for political agendas, right? And our research agendas, which are political, right? And we need to explicitly recognize that they are political, around race, around inequality, around thinking about issues of distributive justice. And we also need to then realize that we are either then working within these structures, either to serve the status quo in terms of the existing power structures, or we are working to challenge it. And this is how I view my work. And I think this is how we kind of de facto operate, even if we don't specifically state it in economics. So what that means then is that we need to really be careful and understand whose story we are telling, right? So that you often hear this term, you don't know what you don't know. So in my research, for example, in development economics, there's this literature about the effects of colonial investments in infrastructure, mission schools, et cetera, on long-run outcomes, right? And this research often gets framed as, you know, if you had a railroad, if you had a mission school, you have these positive economic outcomes today. And one of the things that I'm from Nigeria, and I started to think about was like, well, who built the railroad, right? Who built the school? Oftentimes it was domestic forced labor that went into building these infrastructures. So we need to think very carefully about what are we saying in terms of the kind of long run or general equilibrium effects of these infrastructures, and what do the implications have for this, for how we frame economic policy right today. So you know, I put these pictures up here. You know, this is the British Colonial Railroad, and just basically saying like, oftentimes we read these we kind of do this research from looking at the point of view of like British colonizers, for example, and their investment in infrastructure, and don't think as carefully about the native populations and the, you know, native Africans building the railroad. And this is Chimamanda Adichie has this nice TED talk about the danger of a single story. And I'll just end very briefly here with saying, you know, I grew up in Nigeria. We used to read a lot of British colonial fiction. Essentially, it was British colonial fiction. And Blyton was like very, very famous. And you're reading these books from the point of view of the 5 white British children in this book going on to the treasure island, right? And not reading the book as thinking about yourself as the African native that she's describing in the book, right? And so then really being able to reorient, like, power frames these stories, these histories, these institutions that we encounter, and then how we then do our own research, I think is very important. I'm just gonna put this up here. This is exactly why we need more diversity. You don't know what you don't know. Our experiences and from our research, and exactly why we need more diversity in the economics profession. And there are really great Black economists that have been doing and kind of banging this drum for years. So I'm glad we're having this conversation right now. Thank you.
Great. Thank you, Belinda. The next speaker will be Sandy Darity about his work on stratification economics. Sandy, you're still muted if you're starting.
Sorry about that.
Great, thanks.
In 2005, I gave an invited lecture to the Academy of Economics and Finance in Charleston, South Carolina. Subsequently, it was published in the Academy's journal, the Journal of Economics and Finance. And essentially, it was the lecture and article that launched the subfield of stratification economics. Now, stratification economics is frequently relegated to the underworld among economists, but it is gradually surfacing as a compelling alternative to the conventional ways in which economists study identity, race and racism, and intergroup inequality. When Greg Price sought to get stratification economics listed as a Journal of Economic Literature category, he didn't get a complete rebuff, but it was assigned to the very last JEL category, Z13, listed as sociology, economic anthropology, language, social and economic stratification. And so there was a flip on the name of the subject to economic stratification rather than stratification economics, and there are attendant implications. But today, the Journal of Economic Literature is preparing a special issue on stratification economics, and my own contribution will be a discussion of the rich possibilities associated with the stratification economics research program. Now, let me say that the core of stratification economics is a structural rather than a behavioral account for disparities between socially identified groups, whether they are distinguished by race, by ethnicity, by gender, or on another basis, for example, religious affiliation. It rejects the view that group-based inequalities are due to group-linked cultural or behavioral norms or practices. It is a synthesis of elements from economics, sociology, and social psychology, and it draws from the happiness studies in economics the recognition that people gain utility from perceived superior status over peers or members of a relevant comparison group. Where stratification economics makes a pivot is by saying that the relative position that's relevant to individuals also must include the position or status of the social identity group with which they correspond. So an individual would be asking not only how are they doing personally in comparison with other members of the social group to which they see themselves as belonging, but they will also be asking how is their group doing in comparison with another. A core hypothesis in stratification economics is the closer the groups are perceived as being in terms of economic or material well-being, the more the dominant group members will be concerned about their overall group position rather than their individual position vis-a-vis their identity group peers. The more distant the groups are perceived to be, the greater the concern will be with personal position and comparison with others in your own group rather than with the comparison of members of the outgroup. There are two ladders of hierarchy that are relevant to this type of analysis. The dominant group has a significant share of members who are above the highest rung of the subordinate group's ladder, and the subordinate group has a significant share of members who were below the dominant group's lowest rung. on the latter. Let me conclude by identifying a set of areas in which stratification economics can provide some insights that will be a strong departure from the ways in which economists think about a host of issues. The first is with respect to wealth accumulation and how we think about wealth accumulation. The second is the theory of identity. The third is the theory of political resistance to inequality. The fourth is the phenomenon of the persistence of discrimination, particularly in competitive markets. The fifth is immigration, where stratification economics has introduced the notion of imported stratification and the lateral mobility hypothesis. The sixth is a reconsideration of the theory of prejudice to treat prejudice as having material foundations. The seventh is the elimination of the debate over whether Trump supporters are motivated by economic anxiety or racism. In the context of stratification economics, those two conditions collapse onto one another. The distinction is dissolved. And then finally, stratification economics points to a way of thinking about the macroeconomic analysis that reverses the usual way in which we think about macro conditions and the conditions of social groups. Normally we ask, well, so what's happening in the macro economy and how does that affect the well-being of individual social groups? But we rarely think about how the structure of relations between social groups might affect macroeconomic performance. And in so doing, we can return to thinking about the ways in which the exploitation of particular groups can promote economic growth, circumstances under which slavery and colonialism contributed to the enrichment of the colonizing powers. So it's not a deadweight loss that you have these types of social arrangements. There is somebody who clearly benefits. And the last observation I'd like to make is I'm thrilled that Belinda Archibong spoke before me, because even though she doesn't say she does stratification economics, that's really what she does. So thank you.
Thanks, Andy. When is the JEL issue coming out? Is it 2022?
I think so, yeah.
Yeah. Thanks. And Mario Small will be the next speaker on with a sociological perspective.
Thank you for the opportunity. I take it you can see the screen. Excellent. As you heard, I'm a sociologist by training, and so everything I say here will be from my perspective quite different from that which you're currently getting. I think everybody here understands better than me the two major perspectives from which economists have studied discrimination. One is the taste perspective, by which people discriminate towards others to the extent they're willing to pay a price to not associate with them. This is Gary Becker's idea. The second is the statistical discrimination idea from Arrow and Phelps, which is the notion that when evaluating an individual, the actor makes a guess about their abilities on the basis of the characteristics of the group. From both of these models, what's important to note, and this may seem obvious to an economist, but it is actually not obvious to a sociologist, that discrimination is an act being perpetrated by an individual who, whether out of animus or not animus, is actually making a decision that's going to hurt somebody else. As a sociologist, I find it quite common and natural to study discrimination from an institutional perspective. And what I'd like to offer is that economists should consider this perspective as well. Institutional discrimination, we define in a paper in the Journal of Economic Perspectives in 2020 as differential treatment by race that is either perpetrated by organizations or codified into law. And the key issue here is that it does not require either a contemporary actor to eschew association with others or aggregate on the basis of group traits. Just 2 slides to kind of show you what I mean by this. You can imagine a situation in which the actor here in red, either in Becker's model, doesn't like yellows and therefore doesn't hire yellows, or makes a guess about the characteristics of this particular yellow on the basis of all others and therefore discriminates statistically. But we can also take into account the fact that this actor is embedded in an organization. If it's a manager, he or she is in a firm. If it's a banker, he's in a bank. whose actions may in fact reflect formal rules or informal practices on the bank itself. Maybe newly hired to this organization, you may not have any animus towards yellows, but you may know that the organization never hires yellows, and implicitly you take that as a signal that you shouldn't hire yellows. But more importantly, the organization itself can actually discriminate regardless of who you are. And this is part of why institutional discrimination is important to take into account. Imagine a norm or a rule, for example, like referral-based hiring that's part of the organization. Referral-based hiring in some companies is explicit. You know, when you apply, the company asks you who refers you. The company gives you a bonus as an employee if you recommend other people who end up getting hired. So this is actually a standard practice. Now imagine a company of all reds. We know from sociological research on networks that networks tend to be homophilous by race. That means reds tend to have red friends. If you have this totally neutral policy of hiring by referral, what you're going to get is a whole bunch of people who are also red because they're being referred through reds networks. This is a context in which essentially if you're yellow, you're less likely to get a chance at getting a job there, even though there's no individual manager today either discriminating against you or making a statistical guess about your characteristics on the basis of your group. A very different way in which this discrimination can happen institutionally is historically. And here I'll use as an example voting laws because I think they're quite useful. During Reconstruction, a lot of Southern politicians started constitutional conventions with the explicit aim and on writing of figuring out how to disenfranchise African Americans in a way that was still constitutionally legal. And these were self-proclaimed white supremacists who used those words, white supremacy, to describe themselves and to describe what they were doing, and who explicitly in newspaper editorials and in the minutes of constitutional conventions, you can find some of the quotes in the paper, said, how do we constrain the Negro vote? What they did is essentially through a number of practices, but one of the most common ones was through the criminal courts. It is in fact constitutional to deny the right to vote to people who have committed felonies. And so a lot of crimes based on the racial composition were reclassified as felonies, and there were other things that, that the Southerners did. But the bottom line is that these then became laws that were explicitly discriminatory by nature, such that once in the books, because they're institutional in nature, it didn't actually matter that those people died off, that their kids had different opinions, etc. They were in the books. And once a law is in the book, it takes a long time and it can be very difficult because it's essentially institutionalized to get rid of. And so again, today, what we have is if you're a yellow, if you're African American in this context, your probability of voting simply because you're more likely to be committing a crime that has been classified as a felon is lower, not because of any individual making any decision today, but because of laws that were in the books many years earlier instituted with discriminatory intent. So what I'd like to propose then is that economists consider institutional discrimination as a new set of tools to think about aspects of discrimination that states and statistical discrimination don't quite capture. Thank you very much.
Thanks, Mario. We'll definitely have more time afterwards to follow up. The last panelist is Chad Jones, who will talk about his work in macro.
Great, thanks very much, Jan. And it's really a pleasure to be on this panel. I think that the big picture point I wanted to make is perfectly illustrated by this conference and by the panelists' remarks already. And that is that I think these problems associated with race and gender are so large that they need each of our specialties to contribute. And certainly the heterogeneity of perspectives we've got on this panel, and at this conference illustrates that. I wanted to discuss very quickly two things that I've worked on recently that bring a macroeconomics perspective. So even macroeconomists can potentially have something to say about these issues. And these are two papers here, one with Shay Hurston-Clino and one with Jean-Felix Bruyette and Pete Clino as well. So this first paper is the allocation of talent in U.S. economic growth. It begins with an observation that everyone's familiar with, and yet still is stunningly striking when you see the numbers, I think. And that is that if you look at high-skilled occupations like doctors, lawyers, and managers, in 1960, 93% of those occupations were occupied by white men. And by 2010, 50 years later, the fraction that was consisted of white men had fallen to 60%. There are wonderful stories associated with these statistics too that we mentioned in the paper, where Sandra Day O'Connor, the future Supreme Court Justice, who graduates from Stanford Law School #3 in her class in 1953, and the only job she can get is as a legal secretary in the private sector. And David Blackwell of contraction mapping theorem fame, and therefore near to our hearts as macroeconomists. And this one, his story, actually, I learned about. It has a Minneapolis connection from Ed Prescott when I was presenting this paper several years ago. I won't go into the details of the stories, but I'll encourage you to check them out on Wikipedia because they're really interesting. Okay, so in this paper, we say, suppose the distribution of talent is identical for groups. So it's identical for white men and black men and white women and black women, for example. Then what these numbers, the 93% and the 60%, tell you is that it was an enormous misallocation of talent in both 1960 and 2010, right? The shares don't look like the population shares, but there's less misallocation in 2010 than there was in 1960. So things had gotten better. And the question we ask as macroeconomists in this paper is, how much of US economic growth over this 50-year period can be explained by declining barriers in the improved allocation of talent? And the thing that shocked us, and in some sense to this day is still quite surprising, I think, is that the numbers are quite large. So something like 40% of growth in GDP per person over this 50-year period is attributable to the improved allocation of talent, sort of declines in barriers that kept people from working in the jobs where their talents were most appropriate. 24% of growth in GDP per worker, so a measure of productivity, and 90% of the increase in labor force participation over this 50-year period. So, these issues are just huge, even from a macroeconomic standpoint, as Sandy alluded to in his remarks as well. A more recent paper, something that's just a working paper right now that we're working on, that looks at race and economic well-being in the United States. And so I've got 3 lines on this graph, and each line is the ratio of an economic index for Black Americans relative to white Americans. So look at the dashed line for earnings. In 1984, the average earnings for Black Americans relative to white Americans was something like 59%, and it rose so that by 2019, it was 74%. So some closing of the gap to some extent, but still a large gap at the end. Look at the green line for another economic concept, and it tells a very different story, and that is that at the end of the 1980s, about 20% Black American wealth relative to white American wealth was about 20%. Okay, and not only did this ratio not increase, it actually decreased slightly. So by 2019, it was down to around 14 or 15%. So the wealth series would relative to the earnings series would tell you the gaps are much, much larger. So what we do in this paper is we ask, well, earnings and wealth aren't the things that enter utility functions that economists like to study. Instead, things like consumption or leisure or how long you live, life expectancy are things that directly enter utility. And so we construct a welfare index that's measured in consumption units that adds up, that uses utility functions to combine consumption, mortality, and leisure differences over time to get a single index that's in consumption units. So it's consumption equivalent welfare is how we think about it. And this tells a different story from both the earnings and the wealth series that you see here. And so by this measure, which is the solid blue line, in 1984, consumption equivalent welfare for Black Americans relative to white Americans at an individual basis was about 43%. And it increased quite substantially, much more than you see the increase in earnings, for example, or wealth, to about 60% by 2010. And then it's been flat for the last decade. And so I think the 2 messages we take away from this welfare series are, first, that the gaps are large, even larger than the earnings gaps that you see even by the end of the sample. So there's still a lot of this misallocation that we talked about in our earlier paper. But there has been substantial progress, much more than we saw in wealth and even more than we saw in earnings. And that's in part associated with big gains in life expectancy, but half the gains are also associated with rising consumption. Anyway, let me stop there. The main thing I wanted to take away from this is that this sort of Big Ten approach to these important questions is useful, and each of our subdisciplines certainly has something important to say. Thank you.
Thanks, Chad. This is great. There's so many ways to go here. So the last paper before the panel and then Chad's discussion now sort of point us to thinking about macro and how to try to, I mean, is there a balance or a trade-off between trying to keep models simple, but also trying to incorporate the richness and say the stratification that Sandy is talking about, and Sandy emphasized that pushing that consideration, up to the macroeconomy rather than saying, we have effects coming from the macroeconomy back to individuals. Maybe we should be taking more seriously what goes in the other direction. So from a methodological point of view, is there a tension there between simplification, which is how we usually think about models, and trying to have a rich, sort of meaningful approach to race in macro modeling, or is this something we should embrace and work with, and if so, how? Anyone want to take that on? Mario, you had sort of hinted in this direction when we talked earlier, so I don't want to put you on the spot, but I guess I'm going to put you on the spot if you would take that up.
Well, I will say first, I cannot speak to the macro versus micro methodological implications because I am not an economist, so anything I say about that would be meaningless. But I do think that there's something to be said about highlighting this tension. So the way I often hear about this, and I know some of the previous panels about that you've organized have been from graduate students. I often hear from graduate students some version of the idea that part of the problem with simplification is that it ignores things like structural racism, or like in my case, institutional discrimination, which are quote unquote too complex or something like that to study, to approach through simplistic models. And I think, I understand the sentiment, but I guess I disagree. And the reason is, I guess there are a couple. One is simplification, I think, is good for science. In the end, we're ultimately leading in some kinds of generalizations. You can't account for everything. But I think what the critics are rightly pointing to is that one can fail to consider whether the simplifying assumptions one brings to a model are appropriate, and one can fail to consider whether other kinds of approaches, which might seem more complicated simply because they haven't been tacked on. So for example, thinking about discrimination institutionally rather than from the perspective of the decisions that an individual actor is making, are avoided for the sake of simplification. So I guess in those two ways, I think maybe those are the ways I would take that graduate student critique in a more positive way. I would say, yeah, what are we doing to make sure that our simplifying assumptions are the right ones, or justifiable, or not blinding us to important aspects of discrimination or race more broadly? And secondly, are there very different kinds of models that our disciplines could be approaching by being a little bit more open to how other disciplines approach things that from ours initially might seem too complicated?
Anyone else want to jump in?
I can jump in as well, just to add on to this idea of, I think actually, I know, again, there are lots of very valid critiques of econ and our modeling, but I think what economics does well is thinking about, this is we say one of the goals of our field is thinking about studying incentives, right? And the study of incentives that people face and the kind of decisions that they make as a result of those incentives. So I think even, starting with that very simple framework of human behavior and how we choose to do the things we choose, then it allows us in econ to study a range of kind of different models, different outcomes, different contexts. I'll give you the example again from, from our work on prison labor. We started out with this idea when we started doing the research that, look, there is a model of incarceration, right, that says you go into prison when you commit crime, right? And so negative shocks increase crime, which increases incarceration rates. And so if you are someone who will only think about the incentive structures facing individuals in terms of crime and incarceration, then anything that diverges from that model of the world will be very confusing to you, right? And so if you start out with that, then you miss the kind of the impacts of other historical institutional contexts, like, for example, thinking about convict leasing or thinking about in British colonial Africa, the fact that the British are trying to maximize colonial revenues and they are trying to minimize the cost of administration. So they are going to use domestic forced labor, cheap labor, right? And then what that would mean is that you could actually see, given those set of incentives, right? Once you understand from a historical perspective, those set of incentives, you can actually see a situation where positive economic shocks then increase the incarceration rates because of the demand for labor. So economics has the tools to understand that, but the problem is sometimes when we're very kind of, some people are very, what's the word, resistant to examining history and examining sociology and examining institutions, and then they stick to just one version of the model of the kind of nice general wide variety of models that is available to us in studying incentives as economists.
Yeah, I think although the behavioral economics revolution represents a bit of a departure, one of the core themes in economics that I remain strongly attached to, and this is related to Belinda's observation about the focus on incentives, is that people, given their information and beliefs, behave in a manner that is actually rational. And that the activities of social groups that are comprised of individuals are typically can be understood as being rationally motivated from the standpoint of the collective interest of the members of that group. I actually call for economists to bring back their emphasis on rationality, because unfortunately, the types of exploitative activities we observe in the world actually do serve somebody's interest.
Great comments. Chad, did you want to wrap up? You've done macro modeling.
Sure. I think this is a real tension that we see in macro papers and papers, in economics and other disciplines all the time, which is, the world's a complicated place. And if you want to understand the world, you may think you need 37 or 87 ingredients in order to make sure you're going to understand it. I think that's exactly true. And I think many of us are sympathetic to that view of the world. On the other hand, I think we only start to understand something by simplifying. And I like the way Mario put it, which is, what's important is to make the right simplifying assumptions and be open to the fact that maybe the assumptions we're making aren't the right ones and we need to consider other ones. And I think, when modeling's done really well, I think it's very clear what its assumptions are. So you could see, okay, that one I don't believe in, and I think I could make a different assumption that would be better. And so I think simplification has been a really useful tool, but the world's a complicated place. And so this tension is just a healthy tension that we constantly need to engage with.
Oh, maybe we give a little more thought to the assumptions before we charge up our macro model in the form we're familiar with. Mario, a question came in the chat. You emphasized networks and how the informal arrangements and connections like referral hiring can sometimes get formally codified, but even if not formally codified, they're sort of codified in practice, and it cements whatever biases or even formal discrimination that arose initially. And one of the questions was whether does technology change that? So suppose you have hiring practices that are aided by technology, so you can reach a broader group of people. Maybe you can anonymize some aspects of the hiring process.
Yeah.
The other thing that I'm going to interject that I worry about is sometimes, you know, the AI just cements our own biases. So are you an optimist on technology?
Yeah, that's a great
or
question.
how do you think it?
Yeah, and I would say I'm not. So I look, I think there are certain things that for sure will happen. And here I want to reference, there's a paper on discrimination and algorithmic decision making that's really relevant. That's written by Gus Sunstein, Sendhil Mullainathan, and a couple of others. In other words, it's a really thoughtful paper on this. I think the changes in technology are likely to have the biggest beneficial impact on both benign and highly self-aware actors. And I think, in other words, if you have employers who want to make a difference and are extremely thoughtful and know a lot about how their decisions implicitly or explicitly may have unintended consequences, that's the space where you might see the sort of strongest benefits from this. The problem is a lot of discrimination. And if we were living in a world where most, for example, employers discriminated because of taste reasons or because of statistical discrimination, then you could get the non-benign ones, presumably by imposing kind of mandating or requiring or having the market encourage more technologically driven hiring, and the latter presumably would get it at the self-awareness. But the problem is that a lot of discrimination doesn't happen that way, right? What's powerful about the example that you reference about network hiring is that everybody in that company can be, you know, very pro hiring people of different races and very benign, et cetera. It's just that value neutral, race neutral practice that was codified. And there's lots of other race neutral practices that exist that can very easily just translate into a more technologically driven format. And so to the extent that race neutral or race blind practices can exist, I don't actually think technology itself is going to solve this. I think what you need is far more perspectives on the question from the perspective of managers than simply taking those managers and giving them more technology.
I like your dichotomy between the benign and the highly self-aware. I'm trying to imagine what the distribution of those two groups looks like. And we saw some materials in this series and effort from the Institute, and the Minneapolis Fed has been going on for a while, and they had an earlier session where they were talking about economists within the profession, and young economists were given the advice to in their research to, you know, follow your passion and, you know, challenge the dominance of, you know, leading journals and work on what really excites you and motivates you. And then we read some feedback, especially from young economists who said, you know, that sounds really exciting, but also risky and frightening, who are, you know, trying to navigate the publication process and advancement in economic research. So, you know, you've all navigated this process and have published papers and have challenged in some ways. Do you have advice for the next generation coming up? Are there things they can do, or tell them to forge ahead? What would you say to the next generation who wants to follow you? challenging. Hard question, Belinda?
I don't know if I'm the right person to go first, since I think I am the most junior person here, and I'm still navigating this currently. But I will say, so my research, I'm a development economist who does work in economic history and environmental economics. And so I've for years been doing this work on prisons, and then I've been doing this work on epidemics as well. Like I always tell people, I did this work before 2020. And when I started doing the work, my perspective has always been just kind of follow, we spend so much time, researching these topics. And so really, I know it's not, from a career point of view, it might not be maybe the kind of optimal strategy, but I think, if you have a long-term view in terms of your goal is to say, for me at least, how is my research actually going to make a difference in terms of fact, and maybe, yeah, I know that sounds very like, ooh, make a difference, but really, like, how is my research actually going to make a difference in the communities I care about, in improving the inequality and the outcomes that I see in my own community, and how is this going to actually impact the world in a kind of long durée or long-term approach? I think that's, if you take that stance, then these topics that we study are always there, right? And now epidemics are popular, I guess. We're in a pandemic. And now it was like, all of a sudden, all these papers that we had been writing, the journals were asking for. People reach out to me to say, please come tell us about the economics of epidemics. Like, we want to know more about how epidemics affect inequality. Now, all of a sudden, my papers are going through in the journals. Same thing with the prisons. We're doing this work, and people are like, why should we care about incarceration and historical perspective? And now, the protests were happening around Black Lives Matter, and these topics started coming back, and it was like, oh yeah, we should care. So I think, thinking about what it is that you want your research to have an impact on in a more long-term way will also, I don't know, again, I'm still at the beginning, hopefully, but my hypothesis is that it will also then lead to kind of future research from the point of view of success of our profession in terms of journal publications, etc. But I'll let Sandy and everybody else's words to get a bit talk, but that's just my perspective on that.
Well, on the issue of journal publications, I mean, the fundamental determinant of what appears in the journals is associated with who the editors are of the journals. So if the journals are to be more open to the types of research that focuses on questions of structural racism and inequality, then we probably in general have to have a different set of editors for most of the journals. I know that about a decade ago, I did a paper called Notes from the Back of the Academic Bus. And it was a short piece in which I was trying to examine ways in which the economics profession excludes research that focuses on what we may now want to call systemic racism or structural racism. And one of the things that I discovered at that point, and I'm fairly sure this is no longer accurate, but at that point, there was no single Black economist who was an editor of any of the AEA journals, not chief editor, not an associate editor. There was not a single one, and that was inclusive of all of the journals, especially the second tier journals like the AEA Journal for Applied Economics, microeconomics. There were no Black economists who were editors. Now, you can find Black economists who probably don't think very differently from a large number of white economists. But if you have none at all, then that really does load the die.
Anybody else on this question? Well, we have about 5 minutes left. So what I'd like to do is ask each of you to give, your last parting, what do you want people to know from this panel? And so I'll talk for a second here to give you a chance to think about it. Because our mandate is to look at race in economic research. So it's been a rich discussion. So can reiterate an important point you've made already, or if there's something you think we overlooked, I'd like to give us a chance to close with your parting thoughts. Anyone ready to take the mantle first?
Maybe I'll say something quickly just to take the low-hanging fruit. I think I think things are getting better. I think it's illustrated by conferences like this. I think there's an awareness that there are important issues that maybe haven't been addressed as much as they could be in journals or conferences or by economists or by researchers more generally. And so I would just encourage people to, find those topics. I think the earlier conference was right. Find those topics that you're really fascinated by, work hard on them, work to simplify and communicate as effectively as possible, because I think there is growing interest. So there's lots of opportunities going forward.
Right.
A year ago, after the death of George Floyd, and when a process of racial reckoning was beginning in the United States, the AEA's executive committee specifically urged, and this is their language, all economists to seek out existing scholarship on race, stratification economics, and related topics. And I would like to echo that urge, but also invite economists to become very closely engaged in the stratification economics research project. I think there's a tremendous amount that we can learn through the lens of stratification economics, and it would be wonderful to have even more compadres doing work in this area.
I can just chime in with just to since Sandy made it easy, to reiterate what Sandy said on thinking about and reading very closely. Again, I briefly mentioned it last time, like Black economists have been doing, people like Sandy, people like Lisa Cook, etc., have been doing really, really excellent and important work thinking about these issues of race and inequality and power and how that affects economic outcomes. And I think, I want us to forever scrap this distinction. I tell my students from in intro from day one that there is some sort of distinction between positive economics and normative economics, right? I always tell them all econ is normative. Don't let anyone lie to you and tell you differently. And I think we as economists need to realize that as well, right? Regardless of whether we know it or not, our research, our work is serving some political agenda, whether we want it to explicitly or we don't. And I think really then once we realize that, being very careful, again, in studying these scholars that have come before us that have been thinking about these very important issues of power and inequality and stratification economics, then becomes even more crucial. So I'll just end there.
Thanks. Mario?
Yeah, I guess, I'll say briefly that as an outsider, to me, I see economics, and I actually have at least two reasons to be optimistic from the perspective of young people looking to get into this. The one is that if you go back to the last period in which there was a lot of social activity nationwide around race, so of course the late 1960s, the parallel to 2020 was probably 1968. And if you look at the papers that today are the seminal papers that set the stage for 30 years of conversation in economics about discrimination, they came out in 1971 and 1972, just 3 years later, right? The field was open. Becker and Phelps and Arrow wrote right around that period. So I suspect that now there's probably more openness than even a few years ago to these kinds of questions, such that the field is probably waiting for the next very much improved Becker and Phelps and Arrow with the much more demographically diverse, or somewhat more demographically diverse field that you have now. The second reason I think I have for optimism is sort of, if you, again, as an outsider, if I look at the economists I most find interesting, and many of them have won Nobel Prizes and other sort of notices of success, a lot of them were rejected in the early papers, and a lot of them got Nobels for work that most directly challenged the field. George Akerlof is one of my favorite scholars anywhere, and I love hearing his stories about how his paper on the market for lemons was rejected from every major journal multiple times before he finally got in. I suspect there's going to be a new generation of that, people fighting against some conservatism from editors, but eventually, if they keep at it, actually making a change that generations later will be felt. So for those two reasons, I actually have a sense of optimism about what could happen in the future.
That's a great note to end on, Mario. I want to go back to Sandy's invitation to join the work, to join the literature, and use Belinda's words actually from her initial presentation, which was, you don't know what you don't know. And instead of being a description, to take it as a charge. So thanks to all of our panelists. It's been a fascinating conversation. I learn more every time I listen and talk with all of you. And turn it back to one of the organizers, Alessandra, who with thanks brought us all together today.
Thank you so much, Jen, and thank you to all our panelists. I myself have worked on the issues of gender and discrimination, and I learned so much today. And I feel that the time has changed and that we started a process, and we don't want to see this, process to stop. We have to keep talking to each other and learn from each other. And I think today we moved our understanding of race and, racial disparities, their origins, quite a lot. And I thank everyone, and I hope to see you soon again, in another one of these conversations. And I will take a little break, and then we'll come back when Rob Valletta will introduce the next session. Thank you to all. See you soon.
Thank you.
Kyle, I'm going to give it about 1 minute.
Okay, so let me know when you want my slides up.
Sure.
Thank you, Rob. Hope you're doing well.
I'm going to go ahead and get us started again. Welcome back. It's been a great conference so far. I'm Rob Valletta from the San Francisco Fed. I'm just going to be serving as the Q&A moderator for this upcoming session. Continuing on the themes from this morning, we've got a couple papers that talk about heterogeneity or unevenness in outcomes across groups and individuals, and also the role of monetary policy. So our first paper is going to be presented by Kyle Herkenhoff from the Minneapolis Fed and the University of Minnesota. He'll be talking about changing income risk across the US skill distribution, evidence from a generalized Kalman filter. Kyle, you have 20 minutes, and then we'll have a discussion for 10 minutes after that. So Kyle, please take it away.
Thank you. Let me get this screen up. Hopefully you can see this. Boy, I'm having
I think maybe it's just being slow because it's showing that you're starting screen sharing, but nothing is showing yet.
Okay, so let's see if this works now. Are you seeing my screen?
Yep, that looks great.
Okay. Just make sure slides are moving. All right. So this is joint work with Carter Braxton, who's at Wisconsin, John Rothbaum at the US Census Bureau, and Larry Schmidt at MIT Sloan. And the standard disclosure applies. These are not the views of the census or the Federal Reserve. These are my views. So the question that we're after in this paper is, for whom has persistent and temporary earnings risk changed over time, and why? So for those of you who are not knee deep in this literature, persistent risk is the type of income shock where you see this propagate forward, change your future path of earnings potential, versus temporary risk, which is something that comes and goes. What's the motivation for this paper? Well, what we've got our hands on, and with the help of John Rothbaum and the folks at the census, is new administrative data linked to the CPS survey data. This data is going to provide us with a unique opportunity to open up the black box of earnings dynamic risk. So if you've seen papers in this literature, typically researchers use generalized method of moments, GMM estimation, to try to estimate earnings risk, but they can't go back and tag the people and say who got a shock when and why. So we're going to solve this issue by combining two fairly well-known methods, the Kalman filter, which I'll go through in a minute, and the expectations maximization algorithm, which we're going to use, but not describe in great detail because this is a 20-minute talk. So what do we get out of this? What it's going to allow us to do is to model arbitrary spells of zero earnings, so unemployment. And relative to the existing literature, we view this as a significant advance. While there's some methods that have ways of dealing with zeros with some restrictions, this is arbitrarily flexible. You can allow for extremely long periods of people dropping out of the labor force and earning nothing for 5 or 10 years in some extreme cases. The expectation maximization algorithms allow us to easily estimate these income process parameters. It's going to be approximately an OLS regression or a GLS regression. It's going to be fast and scalable. We can run this for 24 million observations over the lunch break. What the Kalman filter is going to do, you can envision this as adding 2 new columns to your data set. So what's going to happen is for every individual in every time period, for instance, if I were in the data set, it would have my earnings split between persistent and temporary earnings in each time period in which I earned income. We're going to apply this to Social Security Administration data that's been linked to the current population survey, which is a large survey on which a lot of labor force statistics are built. We're then going to ask, well, is this technology that we're using, this Kalman filter, actually recovering labor market risk by using the linked survey responses? In the CPS, we see a variety of shocks, job loss, disability, et cetera. We're then going to partition the data into very fine intervals. We're going to look at occupation, we're going to look at gender, we're going to look at race, we're going to look at all sorts of characteristics of individuals and ask, well, in which of these groups have we seen income risk going up and why? So what we find is that since the 1980s, persistent earnings risk has risen by about 10%. Which is, and we're going to show later in the paper, results in a large welfare loss for the typical US household. And the scarring of the unemployed has worsened. So when you lose your job, your earnings drifts downwards almost 50% faster. So you can think of the job ladders getting taller, and when you fall off, it hurts more. So why is earnings risk changing? What this method allows us to do is really dig into and assess a number of theories for rising persistent earnings risk. What we're going to do is find that this is primarily a high skill phenomenon. College-educated workers are going to face the largest increase in risk. And contrary to many existing narratives out there in the press and in the academic literature, this is not a phenomenon that's being driven by, let's say, low-skilled men or construction workers, and potentially not being driven by Rust Belt related hypotheses. We're going to find that workers in non-routine, cognitive, and computer-intensive occupations have faced the largest increase in permanent earnings risk. It's unrelated to the routine content, and we're going to have some evidence that tells us that it doesn't have to do with Rust Belt-related stories. This isn't a story about the decline in manufacturing or decline in unionization rates. But it's not to say that high-skill workers, let's say, overall are worse off over the last 40 years. What we're not mentioning here in this paper is the first moment, is the average levels of earnings. So really what we're seeing is low-income workers earning quite a bit less, but those earnings being quite stable. So you can envision a stylized synopsis of this paper is minimum wage workers really have low income risk because they go back straight to the same minimum wage job that they were working at before they lost their job. At the high end of the labor market, the ladder is getting taller and taller. And so when you fall off, it looks like larger increases in earnings risk. In terms of welfare, we're going to find that this particular income process that we estimate, which allows for people to fall off the ladder, allows for periods of zero earnings, is generating the large increase we've seen in persistent earnings risk has generated large welfare losses. So agents in our model were willing to give up 2.5% of lifetime consumption to stick with the 1980s persistent earnings risk. So let me show you how this works graphically. So there can be a mix of equations and graphs, and hopefully the graphs give you the intuition for what the equations are doing. So what's a standard income process? It would take log observable earnings, which we have residualized with respect to age and birth cohort, but just think somebody's earnings. And we're going to split it into a persistent and a temporary component. So what we've done here is draw an example of our sample data. So you can imagine each of these black dots is a Social Security earnings record. And in these 2 years, this person earns zero earnings and then bounces back. And I should say this is made up data, right? This is nobody's actual income process. This is just made in Microsoft PowerPoint. So this is their Social Security earnings for a sample record. And what we're going to do is split it into a slow moving component and an IID component, this temporary component. You can think of the persistent shock, sort of a low-level version of what we're doing is you're just taking out a moving average from the data and you're saying the slow-moving component, that's what we're going to tag as persistent. And then the rest of it is what we're going to call temporary earnings risk. The problem with that is these methods really have no way of dealing with periods of zero earnings. If you're working with log earnings, which is quite standard literature because you want to talk about percent deviations, you really have to make an arbitrary assumption of what the scaling is at zero. So what we're going to do is augment this income process. We're going to allow for periods of zero earnings in the following way. We're going to posit a law of motion for persistent earnings, which is persistent earnings today is an autoregressive process, persistent earnings yesterday. We're going to allow for a drift of persistent earnings when you're employed and when you're unemployed. And we're going to allow for these innovations to persistent earnings, which we're going to call persistent earnings risk. The variance of the temporary earnings risk is R, and for those who are employed, it's QE. We're going to allow for a separate income process for whether or not you're employed or you're unemployed. When you're unemployed, your earnings is missing by definition. What the Kalman filter allows us to do is use theory to posit what the law of motion should be for your persistent earnings when you've lost your job, and then to estimate this theory using reemployment earnings. When you're unemployed, you're still going to face a similar AR1 process for persistent earnings, where when you're unemployed, you have a potentially faster rate of drift downwards and a different level of persistent earnings shocks. Where do we get the data to discipline your earnings when we don't see your earnings? Well, it's precisely when these workers come back to the labor force. The dispersion in their earnings and the mean of their earnings when they come back tells us by how much their earnings drifted down and what kinds of shocks they had to their persistent earnings. If you want to put a different label on persistent earnings, you could think of it as the worker's human capital. So the human capital follows this relatively smooth process. And when you're out of a job, your human capital is depreciating. And when you come back to a job, you have some notion of what your human capital is based on your earnings. So the benefit of the data that we've got is that not only do we see the Social Security earnings, but in 2 years for each of the respondents in the March CPS, we're also going to see their occupation, their education, their geography, etc. We're going to have very detailed data on shocks that have occurred to these individuals in these years. So the name of the game is to estimate this income process. And then in the years in which we also see them in the survey, to come back and say, well, are we actually picking up risk? Are the people who have large persistent earnings losses also those who are laid off or report a new disability, et cetera? The way that we estimate this framework is using the EM algorithm. I'm not going to have time to go into the details, but basically it turns a likelihood function, the full information likelihood function, to something that we can estimate, take first order conditions of with respect to using the information we get out of the Kalman filter. So let me show you the estimates. Let me get to the economics of this. So income is pretty autocorrelated, autocorrelation coefficient of 0.94, a drift upwards when you're employed of moderate 0.4% a year. The earnings risk, hard to interpret on its own, so let me just highlight 2 values that I want you to take away from this. For people who are employed, their persistent earnings risk takes a value, the standard deviation of the shocks to persistent earnings risk takes a value of about 0.22, the variance being 0.22 squared. For those who are unemployed, what we estimate is almost a doubling of the persistent earnings risk that they face. So job losers, income is no surprise, enormous persistent earnings risk. Why does this matter? Because when we go to the time series, we're going to argue it's very important to take into account what happens to job losers when we're talking about income risk. Second, we find an enormously large scarring effect from unemployment, a drift downwards in persistent earnings of almost 15% per annum. This is an extremely large scarring effect. So our estimates picking up something that is actually a shock in the real world. So what we do here is use the years in which we've linked the SSA and the CPS data to compare the recovered earnings risk that we see among those who report a layoff in the CPS. So what I'm plotting here are heat maps. On the left-hand side are people who are not laid off. These are those who are employed. On the right-hand side are people who actually said, I lost my job in the last year and I spent at least a week on layoff. The darker regions are the region where there's more mass. On the y-axis is the temporary shock. On the x-axis is the persistent shock. If we were to look at this and say, where's the most mass? For those who are employed, it's all around basically zero. Very small income shocks up and down. There's some extremes that are actually out here, which correspond to job switchers, and we look at in the paper, but most of the mass is centered in zero. For those who are laid off, the majority of the mass is centered at those with extremely large persistent and temporary earnings shocks. So what do we take away from this? We take away that this method where we've pulled out this persistent component, this blue line, in the years in which we see the CPS, it looks like we're actually picking up what look like observable significant labor market events. So how has earnings risk changed over time? The central question of this paper. What I'm going to do here is plot the difference in earnings year to year, just plot the standard deviation of that guy. I'm going to normalize it to 100 in 1985, and so everything is relative to 1985. As my colleague Fatih Guvenin has shown in a paper that made a very big splash, this measured earnings risk is relatively stable, if anything, declining. Now, what matters for welfare is this decomposition between persistent and temporary. And what we find is that temporary earnings risk has declined, and the variance of those innovations declined by almost 10%. So it went from about 100 in 1985 to about 90 or so in the 2010s. On the other hand, we found that persistent earnings risk, the size of those persistent shocks that's hitting the employed, has risen by about 10 percentage points. So what I want you to take away from this is that while earnings risk overall might be fairly stable, what we're seeing is the type of earnings risk that people really care about when you fall down and stay down, that has gone up. Those innovations have increased since the 1980s. And we're going to show you that using very standard modeling methods, you would say people really dislike this increase, this rise in earnings risk. This is generating significant welfare losses. It opens up the question of how do we ensure these losses, which we're not getting to in this paper, but we view as important future research on the topic. So there's been debate about how earnings risk has changed over time. And there's been debate about whether or not it's sensitive to whether you include zeros or not in the data set. So what we do in the following sequence of lines I'm going to add to this plot is we lower the earnings cutoff. So we go to 1/4 part-time at the minimum wage to be in our data set as an employed individual. And we plot their earnings risk over time. And that's given by this black line with the circles on it. We see again about a 10% decline in overall earnings risk. If we split this between transitory and permanent, we see a similar decomposition. Transitory earnings risk, temporary earnings risk has fallen by almost 20% between 1985 and the 2010s. And on the other hand, persistent earnings risk has still risen by about 10%. So we're finding that the earnings thresholds and whether or not you add these people to this data set who have very little earnings affects the overall trend, but doesn't affect the headline result that persistent earnings risk, the stuff that we care about, has risen enormously over the last 30 years. What about scarring? So one of the benefits of including unemployed people in our analysis is we can talk about the rate at which their earnings potential drops when they lose their job. So it's a negative number, so everything here is normalized to -100, more negative, worse. So what we see is that the rate of drift has accelerated, and it's accelerated by almost 50%. So when you fall off the ladder, the rate at which your earnings potential declines is accelerated by almost 50%. So to summarize the time trends, we see persistent earnings risk has increased, temporary earnings risk has declined, and the unemployed somehow face larger scarring rates. The question that we then ask in the rest of the paper is, why has persistent earnings risk increased? We're going to answer this using the CPS demographic information, and Kalman combined with EM makes this analysis feasible. It's going to allow us to test 4 hypotheses. We're going to test whether or not the rising permanent earnings risk has to do with declining employment prospects of low-skilled workers, in particular this narrative of low-skilled male workers leaving the labor force. Whether it has to do with the decline in the Rust Belt, decline in manufacturing, decline in union coverage, whether it has to do with declining employment wages in routine occupations, those which we think have been automated over time, and whether or not it has to do with high-skilled workers who are exposed to new technologies. And what we're going to argue in the paper, and I might not have time to get through all of these, is that really what's happening is that it's a high-skilled worker phenomenon. It seems to have to do with technology adoption, the really severe earnings risk rise that we're seeing in the data. So how do we make this point? The first piece of evidence that we present has to do with education levels. So it's quite rare in these administrative data sets, especially in the United States, that you would see actually reported education levels, especially since the decennial long form stopped collecting that information. So what we see is that among college grads, persistent earnings risk has risen the most. So the red line here is college grads, the black line is less than college. 1985 normalized to 100. We've seen among the college a steeper rise, although we've seen this in both groups of households. So Rob, I have 1 minute. Is that okay? So I'm going to show just 2 more results and then wrap up. The scarring effect the unemployed is much worse among the college grads. That's what we see here, this red line, relative to the less than high school grads. In the paper, we go through a number of different hypotheses. We look at Rust Belt related stories, we look across states, and we find that when we run regressions of changes in state level earnings risk on initial manufacturing shares in 1980 or union coverage, we see no relationship there. We don't see any rise in earnings risk among routine occupations. And in the paper, really build the case that high-skilled workers have greater earnings risk. I'm going to leave this. I'm going to do one more graph. So on the x-axis here is non-routine cognitive analytic skills binned into percentiles. So this is the highest skills. This is the lowest skill level. And on the x-axis is the change in the permanent earnings risk. And what you see is the high-skilled, almost perfect linear relationship with the high-skilled workers have seen large increases, the largest increases in permanent earnings risk. So I will leave it there and conclude and just say that we've seen a large increase in permanent earnings risk. I haven't had a chance to go through this, but this translates to significant welfare losses for the typical American. So thank you very much.
Thank you, Kyle. That was impressive covering that in basically a 20-minute time slot. So we have a discussant up next, Elena Manresa from NYU. Will discuss the paper. You have about 10 minutes, Elena, so please take it away.
Yes, hello. Can you hear me?
Yes, we can hear you.
All right, so let me start discussing this wonderful paper. So thank you very much for having me here. It's a great pleasure to be part of this conference. So I'm going to talk about the paper that I was talking about, and I'm going to focus mainly on methodological aspect of the paper. So let me start by summarizing in terms of methodology. So this paper is proposing a new way to study income risk. So what is particular about this methodology is that it's going to focus on recovering the individual paths of the permanent and transitory components of the income process. Right? So typically, we have studied income risk differently. We have targeted the estimate of the variance of these components, but they are going to take a different approach and recover the exact paths because they claim they're interested in understanding, in more detail those. So that is the goal, and that's the main justification of choosing a different way to go. Okay, so they are going to use an impressive data set that links Social Security Administration records with the current population survey. They have about 23 million individuals, so that is a very rich data set. And as you can recall from what I just said, they find these large increases in earnings risk, but mostly concentrated on high-skilled workers, and importantly on the permanent component. Overall, I find that this paper was very impressive, and it was great to read, and I enjoyed reading it a lot. So I wanted to talk about some background on this question. Okay, so the importance of understanding income dynamics is kind of like still one very, very important question in the literature, and in particular in the empirical literature. And the reason, in my view, is because we are interested in understanding how much these shocks are going to translate into other variables, and for instance, like shocks in consumption. So this is why it is very crucial to model this income dynamics in terms of something that is permanent and something that is transitory. Because something that is transitory, we understand that we're not going to be conditioning on that. Only permanent shocks are going to make our consumption, or should make our consumption fluctuate. But what is the key challenge here? The key challenge is that these two components are both unobservable, right? And so this is where the headache starts. So let me talk to you about a more simplified model. So Kyle and his authors, they consider a much richer model, but to illustrate the point about the relationships that I want to raise here, let me just start with this model that is in Bandel, Pisafarian, and Preston 2016. So we have a net log income model in which this income is going to be, as I said, explained by a permanent component and then a transitory component. And we know, or we pose some sort of process for this permanent component. So in this particular case, it's going to be unit root type of so maximal persistence, okay? And the other components, omega IT and nu IT, are just going to be transitory shocks, okay? So as they show in the paper BPP, they say, well, there is going to be a relationship then in terms of the shocks in the income to changes in consumption. And so as you can see here, the change in consumption is going to be a function of the innovation in the permanent component of this income process, right? And this parameter here, phi sub t, actually is going to be a crucial component, a crucial object of interest, because it's going to tell us how these shocks are going to translate into consumption, right? We also have some transmission of the idiosyncratic part of the idiosyncratic component of income, and finally we have another shock, right? So given this canonical model and this connection with consumption, the typical methodology has always been to consider variance decompositions, variance restrictions on the data. And so you can actually see, and this is what BPP shows in their paper, that it is enough to consider these 6 variances and covariance in the data. These together with the model provide sufficient restrictions so that all the parameters of interest can be identified. And so what are the parameters of interest? Of course, the variance of the transitory component here, the variance of the permanent component, as well as the variance of the other stochastic elements. And in addition to those, also the transmission coefficients. Okay? BPP shows that not only these equations provide identification, but they are also efficient, okay? And they can be estimated in 2-period models, right? So you can essentially recover all of these elements, also time varying. Right? Now, what is the take of the authors? The take of the authors is to say, well, let's use another method, right? The Kalman filter. The Kalman filter is a very widespread technique, not only in economics, but in engineering. It's extremely important because it allows you to recover a process, right, that is observed with noise, right? As long as you know the dynamics of this underlying process that you only observe, as I said, with some noise. So it involves 2 different types of equations. It involves the measurement equation, and it involves a transition equation. So the measurement equation, as its name indicates, is about what you can observe, right? So in this particular case, your measurement for the permanent component is going to be your income, and the noise is this transitory component. And the transition equation is the law of motion, right? That is kind of describing the evolution of this permanent part. So indeed, these income dynamics models that we study fall in the category of models that can be studied by Kalman filter, and you recover not only variances, but you recover the entire process, right? Now, this Kalman filter comes accompanied by some additional assumptions. So, of course, this essentially looks like magic. How can you actually recover the true process if you know the exact ZIT, right? It's not only the variance or some distributional aspects. You recover the exact ZIT given that you observe it with noise. So the answer lies in the fact that you have some normality assumptions on the errors, and you have also some independence. However, those are not unsurmountable. The Kalman filter can be robust to some of these assumptions not holding. However, there is a question now about the efficiency of the method that the authors propose. So here I'm gonna propose that this method could be improved, at least potentially in terms of efficiency, if we were to incorporate as additional information the second measurement equation, That is to bring in also the fact that changes in consumption are informative as well about the permanent component, right? And so,
Elena, you have about 1 minute, if possible. Sorry to interject.
no worries, I'm about to finish. Yeah. So why is this important? So incorporating consumption is important for two reasons, because not only the authors could then understand the evolution of the risk, but they could understand as well the evolution of the transmission of the shocks, which is something that is absent in this paper, partly because it was not the goal of the authors, and partly because I am not sure that they can access data on consumption. But if they would, then this would be a very nice way to also understand time variation in the transmission of the shocks. Okay, so is this going to work? Well, it's going to work again as long as both income and changes in consumption can be written as a function of the state space in the language of the common filter literature, and which is, I think, the case. Okay, so that would be my main comment here, that they can do better if they add this, and they can get for free also the evolution of the transmission of the shocks consumption. So to conclude here, this is an innovative take on studying income risk. The estimation of their method, or the properties of their method are going to depend on whether the normality assumptions hold or not. This is something that is not the case in the GMM world, but it's not unsurmountable either. And the possibilities to use additional measures, I think, will be very interesting if they were to have access to consumption data. And that's it.
Thank you so much for those great comments. Kyle, unless there was something really burning you wanted to respond to, we've got some good questions in the chat that I'd like to turn it over to. I think you and Elena can probably have a very productive follow-up. Those were really some insightful comments on a really insightful paper. So I'm going to read off some questions, and I hope people don't mind. I'm just going to go ahead and identify them because they're identified in the Q&A portion. Philippe Schwartzman is asking about essentially the welfare effects, and in particular, how much would high-skilled people give up to have 1980s risk and relative income levels? So in other words, did the higher relative level of income that occurred over those decades more than make up for the increased risk? So he's postulating a trade-off between that rise in risk for the high-skilled people versus the aggregate, the overall gains in income.
So thanks, Felipe, for the question. Thanks, Rob, for hosting, Elena, for the wonderful discussion. And I look forward to working things out with you, Elena. Felipe, yeah, this is something that's at the top of our list. I mean, there's another OIGI scholar here, Simon Monge, who's working on this rise in effectively the college premium, studying, how being a barista went from a job that required some kind of specialized skills, now just pushing a button, right? And how this low skill hasn't really kept up in terms of levels of wages. And we plan to go there. So we just have risk right now, but really, I think probably my hunch would be the rise in the levels of earnings among college educated workers more than made up for the risk that they faced.
Great, thank you. And we also have a question from Lowell Ricketts, who likes the paper, and is wondering if you could give us some thoughts on the greater exposure to technological change among high-skilled workers and how it might cause them to fall off the employment ladder. What types of technological change might we latch onto as representative of this?
Great, thanks for the question, Lowell. I'm getting a little bit of lag on my end, so please let me know if my mic is cutting out. So what we did was just quite innovative. Is Carter Braxton and Bloody Tasca, Burning Glass, have vacancy data with text in those vacancy postings. And what Carter and Bloody did was extract the computer requirements of those vacancy postings. And so that's really what we're looking at here is, are you required to learn Python, right, in this job? And then did that occupation also have a rise in interest? The answer is yes. So really think about computer requirements.
Great. And your fellow presenter who's up next, Claudia Macaluso, has a question, related question to the one you just answered, that's basically about the rise in contingent work, temporary workers, contractors, leased workers, and so on, and whether that might be playing a role in the increased earnings and income risks that you've documented and analyzed.
Very much so. I mean, so we're working on some follow-up papers right now. Definitely high on our list. So in the CPS, we see whether or not you're part-time or full-time, and we have self-employment, right, which is the majority of how these contractors would classify themselves in a survey. So we're working on applying this method to entrepreneurs more broadly with contractors, and look at income risk and how those individuals smooth these risks over time. So yes, thanks for the question. We're very interested in that. We do not have the answer yet.
So I'm actually going to exercise the moderator's prerogative and pose the final question myself. So one question that's kind of underlying this but hasn't come up or doesn't appear to be discussed in the paper is whether there are direct policy implications of this. So my own personal area is working on unemployment insurance, and there's a lot of talk about reforming the UI system in the US with these kinds of issues about increased earnings loss, perhaps for higher earnings people, as part of the backdrop for that. Have you thought about that in the context of this work, whether there are implications for UI or other sorts of policies to offset the risk?
We are working towards that. I would say that it's maybe not satisfactory in that literature for us to take an exogenous income process and talk about the optimal policies. So what we're doing right now is taking a search framework and using this as, let's say, auxiliary moments to try to match and talk about optimal policy. And we think the long-term effects of job loss, of disability on consumption, we really don't have that many facts. As Elena was saying, there's some data sets out there with consumption. We don't have that. We need that to talk about insurance. So what we are doing is using IRS. So part of the reason why we have this data is the census has a cross-bureau mandate to reduce respondent burdens. We have IRS hardship withdrawals and other IRS tax information. We hope to use that to try to get at some proxy for consumption. So the hope is if we can see enough about assets and income, we can back out what expenditures are and look at insurance over longer horizons, especially for people who drop out of the labor force and aren't, considered unemployed in conventional surveys. So thank you, Rob, for the question.
Well, thank you, Kyle. Thank you, Elena. That was a great paper and discussion. We're going to turn to the next paper in this session now, and that is going to be presented by Claudia Macaluso from the Federal Reserve Bank of Richmond. And she will be talking about minority unemployment, inflation, and monetary policy. So Claudia, please go ahead and take it away.
Thank you so much, Rob. I can turn on my video. It says the host stopped me, but hopefully I can share my screen. Oh, there you go. Now you can see me. Great. Thank you so much. All righty. Can you see my slide? Can you hear me okay?
Yes. Yes. Yes to both.
You may hear a toddler screaming in the background. I hope that's not too bad. Thank you so much to the organizer for putting the paper on the program, and thank you to you guys are attending. We're very much looking forward to your feedback and to your questions. This is joint work with Munsab and Felipe, and because both Felipe and I work at the Federal Reserve Bank of Richmond, the usual disclaimer apply. These are our own views and not those of the Fed in any capacity. So this work is actually somewhat preliminary, but we felt that there was an important and urgent debate that we would like to contribute to and we would like to be in. And perhaps the conference today confirmed that hunch. So that piece about welcoming your feedback is particularly true. And what is the urgent question that we're looking at? Well, it's the role of monetary policy in addressing some aspects of racial inequality. And I would say this has not been a traditional question for the Fed. The Federal Reserve Act, amended in 1977, establishes a dual mandate for the Fed that is to have two objectives. One, the goal of maximum employment, and two, the other goal is stable prices and moderate long-term interest rate. So you see that in none of those, there's an explicit mention of anything that sounds like inequality or redistribution. However, the crux of the matter is that the interpretation of that clause of maximum employment is actually open the door to the debate. What does it mean to pursue maximum employment? And in fact, I think the president of the institute that is hosting us today, Abigail Wozniak, put it better than I ever could. So I'm just going to quote her. She said, it's true that distributional issues have not generally been at the forefront for the Fed. However, are we truly meeting the full employment part of our mandate when we see such disparate outcomes across demographic groups? And some policymakers have gone even farther. For example, Jerry Bernstein, who's currently at the Council of Economic Advisors for President Biden, said very explicitly that the Fed should take on another task, delivering more racial equity into the labor market. The Fed should consider targeting not the overall unemployment rate, but the Black rate. So when we saw this, meeting the full employment part of our mandate, delivering racial equity, targeting the Black rate, our first reaction was, can the Fed do these things? Should the Fed do these things? What kind of trade-offs are at play? Should Congress decide to amend the Federal Reserve Act in this direction? And this is exactly what this paper is about. We're going to try to answer the question, what would happen? What would be the trade-offs at play in case of these different mandate of targeting the Black rate? Specifically, we look at two specific questions. One is, how does the heterogeneity in both unemployment and inflation across races affect the monetary authorities' trade-off between these two things? That's a sort of a very classic trade-off. What we bring to the table is that the trade-off affects differently different households. In particular, we reaffirm the fact that Black households face about twice as large the unemployment risk than white ones. And we also document a new fact, which is that Black households also face about 16% higher price volatility than white households. Taking these facts, we're going to ask, given that this is the environment the Fed is operating in, how does monetary policy affect the real income volatility of Black and white households? And after sort of seeing the papers today, perhaps this is less of a question, but you may wonder, why would we concentrate on real income volatility? And our reasoning is as follows. We have substantially two things in at play here. One is employment fluctuations, unemployment fluctuations, so unemployment risk. These translate into labor income fluctuation because people who are not working do not earn income. And because labor income fluctuations is typically the majority of a household income, and this is even more true for Black households, this income fluctuation translates into consumption fluctuation. And you may think that people like consumption, but they don't like whether consumption fluctuates from month to month, and that's an important component of their well-being. The second bit comes from these differences in price volatility, and price fluctuation will induce changes in the real income. So this real part actually is important because that's where the purchasing power of a household comes from. And so as purchasing power fluctuates more for Black household than for white household, you'll see again this consumption fluctuation, this well-being fluctuations. So this is exactly what we are going to look at. Let me give you a preview of what we do and what we find, and then we'll go into sort of a bit more details. We set up a stylized framework, which is intentionally simple and sparse, where the main feature is this trade-off that the Fed faces between unemployment and inflation. We're going to discipline the framework with these empirically observed disparities in both the unemployment rate and the volatility of prices. And finally, taking this calibrated framework, we look at a quantitative assessment of this popular policy targeting the Black unemployment rate. What do we find? We find essentially three things. The first one that we think is worth mentioning is that a monetary policy that targets the Black unemployment rate is effectively equivalent to a monetary policy that reacts more to unemployment fluctuation and therefore tolerates larger inflation fluctuations. And this is because of the empirical behavior of the Black unemployment rate over time. Second, we find that the effect of these accommodative monetary policy, this policy that accepts more inflation fluctuations to reduce unemployment fluctuations, such a policy is mediated, the effect of this policy is mediated through two opposing forces. We call these the unemployment effect. So the reduction in unemployment risk will bring about a lowering of income volatility, and the prices effect. This goes through the fluctuations in real income. As prices become more volatile, the real income volatility will actually increase. Now, this is an interesting trade-off and a relevant one in our opinion, because Black households both benefit more from the unemployment effect, but they also have more to lose from the prices effect. So the net effect of these two is ambiguous on Black households' well-being. And in fact, so also on any other household as a matter of fact, but we are concentrating on Black households here. So when we actually quantify these trade-off from the data, we find that if inflation expectations become unanchored, the result of an accommodative monetary policy is actually an increase in Black households' income volatility. And here I'm using anchored in the way of Bernanke, so you should think that inflation expectations are unanchored when they incorporate current inflation shocks into the long run expectation, therefore into tomorrow's inflation. So that's exactly where what's happening. If inflation expectations become unanchored, this policy that looked perhaps a priori unambiguously good actually increases volatility because the prices effect dominate. So now I'm going to show you a few of the facts that we use to reach these conclusions. I'll probably go quite quickly over my model, and then I'll show you our quantitative exercise. The first fact is quite well known, but it bears sort of repeating. What I'm plotting here is the time series for the Black unemployment rate in black and the time series for the White unemployment rate in teal. This is from the CPS from 1978 to right before the COVID crisis. And what you can see here is that the black line is essentially about twice as large as the teal line. And this difference doesn't really change dramatically over time. The gap remains very persistent and very large at all times. However, when you look at the movement over the business cycle, these two series look remarkably close to each other. And that's in the sense in which we say that Black and White unemployment move closely over the business cycle. There's actually very little evidence of lead and lags, and you can test this a little bit more rigorously, but you can also just sort of look at this figure and it becomes somewhat apparent. The first set of facts that we want to bring to the table regards instead price volatility. And this is some novel facts that we have derived from microdata on households' expenditures and frequency of price changes for Black and White households. So these are the two columns that you see in the table. So the main message of the table is that Black households face about 16% higher price volatility than White household. And you see this in the standard deviation of their consumer price index, which is a price of their consumption bundle. Depending on whatever these households buy, the prices may vary more often or less often. It ends up being that the prices for Black households vary actually more often. And you see this also in this frequency of price changes, no matter how you measure it, the frequency of price changes, the percent of the changes that fluctuates every month is higher for Black households. So overall, I think we have sort of the basic ingredients to start thinking about these trade-off. First, Black unemployment about twice as much as white unemployment at all times. However, very close co-movement over the business cycle. Second, the volatility of Black inflation is about 16% higher than the volatility of white inflation. This matters because it means that Black households have both more to gain from reducing unemployment, but also more to lose from increasing inflation. To evaluate this trade-off, we're going to set up a model and evaluate it in a calibration, which is what I'm going to show you next. I want to say this model is intentionally very simple. In fact, the one I'm showing you here is simply to convey some intuition. When we go to the calibration, we'll add a little bit more bells and whistles, but I think that the basic message of the paper goes through here. In this model, there are two types of households, Black and white, and they consume goods whose price is P and housing at price R. And we're going to denote by alpha K the share of income that's spent on goods. In a super simple world, the real income for this household is labor income at the numerator. That's W by 1 minus U, where U is unemployment and W is the nominal wage. And at the denominator, the price index. Now, if you sort of stare at this equation, it really doesn't take much to realize that if unemployment goes down, income goes up unambiguously. This is what we call the unemployment effect. Conversely, if prices go up, then income, real income, goes down unambiguously. And that's the prices effect. And although this is very simple, the whole intuition of the paper that these two things happen at the same time with accommodative monetary policy, and we need to evaluate them both to ask what happens to the income volatility of Black households. Speaking of monetary policy, we're going to model that in a fairly standard way. We posit an inflation unemployment trade-off for the Fed. That's a classic Phillips curve, which you see here in the first equation. Inflation is going to depend on the unemployment gap you had through these slope parameter phi. It also depends on the inflation expectations and on a shock eta. We are going to model inflation expectation also in a fairly simple way to sort of give you a picture. It's going to be a linear function of current inflation through a parameter B, which sometimes are referred to as the anchoring parameter. It bears noting that when B is very low, the current shock, the current value of inflation doesn't really affect the expectations of the future. When B is high, instead, this current value is incorporated into the long run expectations and therefore into future inflation. We also posit a monetary policy rule in which, inflation can react to the unemployment gap. And because we are evaluating this specific proposal, we're going to make it react to the unemployment gap for the Black unemployment rate. But as I told you, the Black unemployment rate we can rewrite as 2 times the overall unemployment rate. And this is where you see that effectively targeting the Black unemployment rate really means using a higher psi, so a higher reaction parameter. So that's the sense in which targeting UB really means having a higher psi, having a more accommodative monetary policy that reacts more to unemployment. If you take those 2 equations together, you can sort of find out these other 2 equations. There's only 2 things that I would like you all to take from this. One is that the problem of the monetary policy really is taking, given this shock eta hits the economy and is going to transfer to inflation and unemployment fluctuations, and therefore impact real income of households. And the monetary policy has to choose how to react to that, how much of that to allow sort of eta to transmit to inflation and how much to unemployment. You can kind of see this here, this how much of the transmission happens is governed by the parameter big psi, which you may be unsurprised to discover that it depends on little psi, which was my reaction parameter over here. So this is the sense in which psi really summarizes how sensitive is inflation to the shock, and to some extent, how reactive is monetary policy with respect to the unemployment gap. The other two parameters that are important and will be important in our calibration are B, the anchoring parameter, and phi, the slope of the Phillips curve. So just keep those things in mind, that they're going to be particularly important in our framework. Okay, so we are close to our objective. What we are trying to do is understand how an accommodative monetary policy, one that has higher values for C, will affect the unemployment rate and the prices, and in particular, given that we have these two effects, the unemployment effect and the prices effect, how these two things are going to play out into the net effect on income volatility for Black households. To make this a teeny bit more realistic, we're going to add rental income so that we can think about the great disparities in home ownership between Black and white households. This also implies that we're going to have a slightly different price index, which you see right here. Then I can write income as the sum of rental income and labor income, and to study its changes with respect to the equilibrium value, I'm going to log linearize it. And this looks like a very ugly equation, but I just would like you to take a couple of things from it. The whole intuition that we had about the unemployment effect and the prices effect being at play at the same time goes through in this, and you can see it. Maybe it's easier to start with the unemployment, the last line in blue. That's where the unemployment effect really becomes apparent, because the fluctuation in income are a direct function of both the fluctuations in unemployment you had and the level of unemployment. The prices effect instead comes into play into the red terms, which specifically are going to give you a differential between the volatility of prices and wages, that's the first term, and prices and rents, that's the second term. And all of these effects are mediated by the share of labor income in total income. So now I've given you a few facts. One is well known: the share of labor income in total income is higher for Black families. I've also shown you that the fluctuations of prices, the volatility of prices, is higher for Black families than for white families. That's going to make the prices effect white. But also the unemployment level for Black households is higher. The unemployment risk is higher. So that's going to make the unemployment effect white. And this is why, basically, with both these things that are played, this is why we need to evaluate them in a quantitative framework. To do that, we have to close the model with some assumptions. First of all, we postulate two periods. The first one I'm going to call short run. This is where all the adjustments happen. And T1 is going to be the long run, when everything has adjusted. What adjusts? It's the prices. All of them start from the steady state value. And then at T0, there's a fixed fractions of them that stays fixed, and the rest adjust. In this fraction, we're going to denote by lambda, lambda P, lambda W, lambda R. These are respectively the fraction of goods prices, wages, and rents that stay fixed. So that's the bit about price rigidity in the model. And similarly, all the prices and wages and rents that instead do adjust, they do so by the same amount. We're aware that this is a pretty stark and strong assumption, so we are working to relax this, but take this as sort of as a first pass. What we are interested in the end is these fluctuations in the real income following the shock eta, how this shock eta gets transmitted to fluctuations in real income for different types of households. And lo and behold, this is the object zeta that you see here. But really what we want to know is how zeta changes when the monetary authority adopts a more accommodative stance. But that's equivalent to that C parameter being higher. So that's why we're looking at this derivative, delta zeta and delta C. And lo and behold, it has a prices effect and an unemployment effect. The prices effect is in red. That's the effect of changing income volatility, changing inflation, keeping unemployment constant. The blue one is instead changing unemployment, keeping inflation constant. And the latter is mediated by some of those parameters that I mentioned before.
Claudia, you have about
I'm going
1
to wrap
minute
up.
or less. Thanks.
Yeah. So this is really sort of exactly what the paper is about. So here we're performing a quantitative evaluation of these trade-offs. Basically, the question is, Is the red bit bigger or is the blue bit bigger? And that's going to decide what's the net effect on income volatility. So in this table, you're going to see two rows, one for Black and white households that come from our calibration. And the first column is the prices effect, unambiguously negative, exactly as we predicted, but larger for Black families. And then second column, the unemployment effect, which is positive and larger for Black families. So positive means it reduces income volatility, negative means it increases income volatility. What is the net effect? It turns out that depends on our B and phi over here. Let's sort of focus on the first two column on the net effect bit. What I want to show you is that depending on the value of B, the anchoring parameter, this policy can actually backfire in the sense that the policy can actually result into a negative net effect, an increase in income volatility, precisely for those households that the policy was set to help, for Black households. And a high value of B, by the way, in this one, we take beta B equal 0.9, and in beta low, in B low, we take it equal to 0. Just so you know, what does it mean? It means that the inflation expectation incorporate current inflation shocks. That's what makes this policy actually ineffective at reducing income volatility from Black household. And this is all I had to say. What have I shown you today? I've shown you two things I think that are relevant to this debate. One is the interest rate rule that targets Black unemployment really is equivalent to one that places more weight on aggregate unemployment. And two, such an accommodative monetary policy can actually end up increasing real income volatility for Black households if inflation expectations become unanchored. And this is because the prices effect dominates. Thank you so much.
Thank you, Claudia. That was a really important contribution to our thinking about the approach to monetary policy and its impacts. Our discussant for your paper will be David Wilcox, who's currently at the Peterson Institute for International Economics, but as many of you know, he was at the Federal Reserve Board for many years. So we're pleased to have David commenting on this paper. Please go ahead and take it away, David.
Thank you, Rob. I'm trying to activate my camera, but the host is apparently standing in the way.
Okay, we will try to rectify that. We can hear you loud and clear at least.
There we go. That
oh,
worked.
good. Okay.
Great. Well, thank you so much. I really appreciate the invitation to read this paper. I benefited a lot from having read it, and I'm going to spend most of my time giving you my top 5 list of reasons for why this paper deserves your attention. Unlike late night TV show hosts, I'm not going to reserve my best reason for last, but just instead give you 5 important reasons. First, the topic is extremely important. The enduring disparity between the Black and white unemployment rates and the disparities between all racial and ethnic groups is one of the central policy challenges in the US today. Moreover, the question of what monetary policy can do about it is an important piece of that overall issue. Second, the paper posits a really interesting stylized fact that was new to me regarding the differential experience of inflation by Black and white families, namely that Black households experience more price volatility than white households do. The authors combine this fact with the observation that labor income constitutes a larger fraction of total income for Blacks than for whites. As I understand it, that matters in their setup because I think labor income is relatively poorly indexed to price surprises. From the combination of these two facts, the authors conclude that Black households are hurt relatively more than white households by positive inflation shocks. Third, the combination of these facts sets up an interesting question, interesting because the answer to it is not, as the authors note, obvious ex ante. Suppose the economy starts from a position of long-run equilibrium with employment as high as it can be without creating additional inflation pressure, and inflation running steadily at the 2% objective. Now suppose the Fed allows the economy to run a little hotter. That should bring unemployment down by more for Blacks than for whites, raising nominal income more than for Blacks than for whites, but it will also raise inflation more for Blacks than whites. So how does it all balance out? A fourth reason to appreciate this paper. It points out, this is a little geeky for those of you who are not macroeconomists, but it points out a reason for favoring a flat Phillips curve. In other words, it casts a flat Phillips curve as a hero rather than a villain, at least in this story. With a flatter Phillips curve, if the Fed accepts an additional percentage point of inflation, it gets a bigger reduction in the aggregate unemployment rate. And because Black workers experience a high beta version of the aggregate unemployment rate, that larger reduction in the aggregate unemployment rate generates a bigger reduction in the Black-white gap in unemployment rates. The more usual casting for the flatter Phillips curve instead of hero is as villain. With a flatter Phillips curve, if the Fed wants to squeeze out a percentage point's worth of inflation, it has to accept a larger increase in unemployment. Both observations are true, but the narrative presented in this paper is a useful corrective to the usual one-sided story. Finally, a fifth reason for appreciating this paper is that it provides an excellent antidote to Larry Summers's remarks earlier this week, which were extremely unfortunate in my view, to the effect that central bankers are at risk of losing control over inflation because they're competing to show who is most woke. For too long, central banks have paid too little attention to the distributional implications of their actions. This paper represents an encouraging further contribution to the growing stream of work that shows there's very serious scholarship to be done in this area, scholarship that can shed further light on the choices confronted by monetary policymakers. As Claudia ably outlined, the key conclusion from the paper is that the question of whether Blacks benefit on net from a more accommodative monetary policy is ambiguous. Accommodative policy generates lower unemployment on average and smaller deviations from the natural rate, and has been documented by many previous authors, the lower unemployment rate disproportionately benefits Blacks relative to whites. Therefore, it advances the objective of central banks and the Fed in particular to adopt an inclusive approach to achieving maximum employment. However, it also generates more inflation volatility, and according to their stylized facts, that volatility falls disproportionately on Black households, largely because a larger fraction of their income derives from labor income. Calibrating their model, they conclude that if inflation is reasonably well anchored, a more accommodative monetary policy indeed leaves Black households better off relative to whites. However, there is a limit. As Claudia noted, if inflation expectations become unanchored, then Black households can be made worse off as a result of a more accommodative policy. I'll leave off by highlighting two issues that we, the economics profession, need to understand better, and this need is illustrated well in this paper. First, what is the nature of the inflation process? In so many ways, right now, through the pandemic experience, we're learning how little we know about how inflation expectations are formed and how little we know about how firmly they're anchored. If inflation expectations are firmly anchored, then a central bank can accept a little more inflation for the sake of narrowing the gap between Black and white unemployment, and that gain will not be eroded over time. On the other hand, if the long-run Phillips curve is vertical, Then central banks must confront the question of whether it is futile to pursue lower unemployment rates for anyone. These are very old issues. They were around when I entered the economics profession, and frankly, it's rather remarkable how little progress we've made in understanding them better. A second issue is that while the differential unemployment experience of Blacks and whites is relatively well understood, the more novel assertion in this paper is that the inflation experience of Blacks and whites differs importantly as well. This is a fascinating assertion and deserves much more study and documentation because it has potentially very important implications. So I'll conclude simply by saying this is a very promising paper. It deserves your attention and it deserves to be published in a very good journal. Thank you.
Thank you, David, for those really helpful comments. We got a few questions coming in, and I'd like to make sure those get some attention. William Spriggs posed a question, and my apologies, I'm going to shorten it a little bit because there's some interesting commentary in there as well, some useful observations. But the basic question part of it is that given the greater unemployment variation during the Great Moderation and the much higher level of unemployment rates reached in the early 1980s, did price moderation policy hurt Black workers more? So the other way of thinking about that is to think about the pre-1980 era when there was less unemployment variation, but much more price variation. And how do those pre and post Great Moderation regimes compare in terms of how we think about monetary policy and its impact on Blacks versus whites?
Thank you. This is a really interesting question. So I guess I'll start by highlighting some limits of what we do that perhaps would clarify some of these. So we're going to take some very long run, both pre and post 1980s, so to speak, look at how these gaps have evolved. And the price data don't go back all that much. So we actually start in the late 90s. So this is the empirical framework I have. When we look at unemployment, we can go back to the 1970s, not quite so much for the price data that I showed you. I think one bit that I wasn't able to really discuss is that we also look at the slope of the Phillips curve, and thank you, David, sort of for mentioning how little we know of that, because that parameter turns out to be quite important for the magnitudes. And it seems to me that your question is hinting exactly at this magnitude issue. What I showed you today is the possibility that such a policy actually yields a negative sign. And I think you should rely on that result. When it comes to the magnitude, the slope of the Phillips curve actually matters much more. So this is something that we are exploring. And specifically the flatter the Phillips curve, as David pointed out, the larger are the benefits for Black households from allowing inflation to have a little larger fluctuations.
Great, thank you. We also have a question from Abby Wozniak, who compliments the paper and asks the following. The paper seems to essentially assume that the Black-white gap in unemployment rates will be persistent. And that seems important for understanding the economy today and its recent evolution. But over time, we certainly hope this gap will no longer hold. Can you comment on the dynamics that might arise resulting from that convergence as it might affect the long run impacts of monetary policy?
Yes, thank you. Thank you for this question, Abby. A couple of things, perhaps somewhat discouragingly, the gap is extremely persistent. It's been there at least since the BLS started measuring it. And it is, I can't find the right adjective. It is just very dismal to observe how it has shrunk so little in the last 50 years. So this is obviously not to say that it's not going to shrink, but it is just to recognize that whatever we are doing hasn't shrunk it. and that's one fact that we need to confront as we think about policy. As for the long run impacts of monetary policy, this is not something that we really look at. The results that I was showing you are really more in the short run adjustment. Specifically, the ones I showed you, you can interpret as a 1 year after the shock. So in that sense, that's how you should see this trade-off, as a short-run trade-off potentially. If I had to speculate, if you ask me sort of to speculate on this, the fact that the unemployment gap is so large is where the unemployment effect comes from, and it's beneficial for monetary policy to have a role in reducing income volatility. So the more it shrinks, the more you lose sort of the positive effects coming from the unemployment effect, and the more weight you'll have to put on the prices effect. Now, of course, there's a question: what is long run inflation? How is that like determined? How are long run inflation expectations determined? These are questions that are tangent to our paper. We don't really get into that, but I completely agree with David's comment. I think it's definitely something that we should, as a profession, perhaps investigate more.
So I actually have a follow-up to that, which is that the effects on the price side are especially interesting. The differential impact of price shocks for Black households versus white households. One might expect, well, so I'm wondering about the source of that. How much of that is due to the different income groups that Blacks versus whites tend to be in, and the different consumption patterns, different shares of rent in total expenditures and so on that they face. And if the difference in price sensitivity or inflation sensitivity is largely because of those features, over time we might expect convergence between between Blacks and whites as well. So that suggests that over time there may be essentially no trade-off. That with convergence in the relative economic status, you don't really get this conundrum for monetary policy. So I guess I'm sorry, that wasn't phrased in the form of a question, but I'm curious about your reaction to that.
No, I think that's a really interesting observation. I guess I have two thoughts on that. The first one is somewhat simplistic. It is true that in the long run, we may not see this trade-off, but we think it's sort of important enough in the short run that we would like to investigate it. And this is perhaps a little cheap, so bear with me. The other more interesting part is that in the paper, we actually look at which expenditure categories account for these differences in price volatility. Where is it coming from? And we have a table. It was too huge to show you today. But what is perhaps interesting, given the debate that we're having today, is that the number one expenditure for Black households is the rent of primary residence. So fluctuations in rents really hurts Black households. Conversely, for a white household, it is the owner's equivalent rent of primary residence. So it's the ownership of your home that really also not only affects the wealth, as we've seen sort of in papers before, but it also affects your exposure to inflation shocks. And in general, you can see that there's a difference between what people would think of as necessities like electricity and gasoline for Black households rank very high. And instead we have some college tuition and field and pets and pet products for white households. So this seems to be driven quite a bit actually by the consumption bundle that different households consume. Thank you.
Great. Well, thank you, Claudia. Thank you, David, as well. Thank you, other participants, for your questions and for listening in on this. If I understand correctly, we are going to take nearly a 10-minute break until the top of the hour, at which point we will reconvene and hear a couple more papers. So thank you all very much, and see you soon.
We'll be starting in just about a minute. Hello, I'm Amanda Michaud from the Federal Reserve Bank of St. Louis, and I'd like to welcome you back to the final part of our conference today. We're going to proceed as we did before. So each speaker will have 20 minutes to present their paper, followed by a 10-minute prepared discussion. And then after that, we'll take questions from the audience. If you're in the audience and you'd like to ask a question, just go ahead and type it into the Q&A box, and then I will relay it to the speakers as time permits. Our first speaker is Trayvon Logan, and he's going to start us off with his research on competition and discrimination in public accommodations. Trayvon, would you like to go ahead and share your screen?
Yes, I need to find my presentations. 1 second. Can everyone see this?
We can just see your folder. I think you have to share the specific window that you have your PDF open.
Everyone see this now?
Perfect.
Thank you. And so this work is joint with Lisa Cook, Maggie Jones, and David Rose, and I'll go quickly through part 1 and focus more on part 2, which is the part of the paper that was posted. So as part of this project, we're looking at racial discrimination in public accommodations. That's been a major focus of the civil rights movement. It's a key area of racial discrimination. The Plessy decision, which is about streetcars, the Montgomery bus boycott, which of course is about public accommodations, the Greensboro lunch counter sit-ins in the 1960s and so on. And it was also one of the most contentious issues for the passage of the Civil Rights Act of 1964. In fact, if the Civil Rights Act of 1964 was invalidated, it would still be possible for 5 states to move back to separate but equal accommodations. Empirically, understanding the evolution of this access has been relatively limited. The question that we ask in this project is how important is legislation and regulation in expanding access to public accommodations? It's a major focus of groups that are marginalized today. And we study the economics of segregation in public accommodations using a historical tool that assisted African Americans in navigating this environment. The Green Books were travel guides that were published by Victor Green between 1936 and 1966. And it included information on hotels, informal accommodations, restaurants, and other services that travelers in particular would access. So what we do in this project in dividing this talk into 2 parts is in part 1, we construct a new data set that documents the evolution of access to public accommodations that are non-discriminatory. And then we look at the trends and the correlates of those Green Book establishments and how they relate to other variables such as economic variables, segregation indices, et cetera. In the second part, we're looking much more economically to evaluate the role of consumer discrimination in upholding segregation before the Civil Rights Act of 1964 was passed. And the question we asked there is, did firms expand service to Black customers in responses to their white customer base changing over time, which we call the market conditions hypothesis? So in both of these sets, we have some summary results. Here is that the geography of segregation in public accommodations shows that there were large gains in the number of non-discriminatory businesses between 1939 and 1955. We stop in 1955, both for reasons of data consistency, but also because 1955 is the start of the Montgomery bus boycott and much more public attention to the issues of public accommodations. We consider this in per capita changes as well, and the number of non-discriminatory businesses overall. The Green Book presence correlates with economic conditions as well as measures of discrimination. In terms of the market conditions hypothesis, we use casualties in the Second World War as an instrument for thinking about changes in the white consumer base. And we find that areas that had 100 more white casualties had an additional 1.5 Green Books in the post-World War II era. In terms of an elasticity, a 1% increase in the Black-white consumer ratio instrumented with these white casualties led to a 2% increase in the firm non-discriminatory to discriminatory firm ratio. And we show that these results are not explained away by Black political activism, increased economic well-being, occupational upgrading, and the like. So we contribute to a variety of literatures on socioeconomic progress in the Second World War, the economics of consumer discrimination, which has relatively little empirical work, and the history of the civil rights movement. So thinking about segregation, it's important to understand that segregation, although we canonically think about it being more entrenched in the South, is actually a national practice. The very first lunch counter sit-ins in the United States occurred in Chicago in the 1940s, a city that we don't think of as being one that had racially discriminatory public accommodations, but did historically. And segregation was practiced in both the North and the South. And John Hope Franklin here talks about it being a wall that existed over the United States in general. There had been some legal desegregation that began as early as 1911. And of course, the Brown versus Board case is the landmark decision that ends discrimination and segregation in public schools. And the Civil Rights Act of 1964 in Title II prohibits discrimination in public accommodations on the basis of race, color, and national origin. Now, Gavin Wright in Sharing the Prize talks about the fact that merchants in general said that they were indifferent about discriminatory practices, but that they understood that their consumers, the white consumers, had strong discriminatory preferences. And they were afraid that if they integrated their businesses, their revenue losses from white customers going to continually discriminating establishments would overwhelm the relative gain that they would get from serving African-American customers. And so if businesses segregating is profitable, is there enough of a margin where the loss of white consumers leads firms to serve Black patrons? And so we're looking at the patterns of access to non-discriminatory services before the Civil Rights Act. We're asking whether firm owners were correct about their preferences for discrimination among their white consumers. And then we ask if market forces would have led to a decline in racial discrimination in public accommodations. So briefly reviewing these trends and correlates, I want to first really go over the history of the Green Books, and I'll spend less time talking about the core. But the Green Book started in 1936 with Victor Green in New York City exclusively, and then expand nationwide shortly thereafter. This is an example of the Green Books from 1956, which lists the establishments by state and location. The listings in the Green Book came from knowledgeable people sending in by the businesses themselves, and also a network of travel agents who were also sending in information about businesses. Taylor's book, Overground Railroad, which is the first published history of the Green Books, claims that their distribution at their peak was 2 million per year. This is the map of the geocoded Green Book locations that we've done as part of this process, where we have the longitude and latitude for each establishment listed continuously over time. The most prominent and typical type of place listed in the Green Books are both formal accommodations, hotels, motels, and eating and drinking establishments, restaurants. Another source are informal lodging. Because of the discrimination that African Americans faced in the formal lodging areas, many people opened up their homes for travelers who were passing by, and that became an informal accommodation, which is very frequent in the Green Books. The Green Books are actually a very good source to look at non-discriminatory businesses. When we compare them to contemporaneous listings, for example, in this graph here from the Wisconsin Business Directory, we find that there are more establishments listed in the Green Books than in contemporaneous discussions of similar businesses that will be non-discriminatory. If we look at this at the city level, it's the same trend, where the green books are overwhelmingly much more accurate or have broader coverage than other data sources, which leads us to believe that the green books we don't believe cover absolutely every non-discriminatory business in the United States, but they're the best comprehensive source and certainly one of the few national sources that list non-discriminatory businesses. The green books, if you look at them over time, continue to expand, especially after the Second World War. And it still is the case that the South had the most green book listings, although the South had the fewest green book listings per capita. When we look at measuring discrimination, what we do for each county is we need a count of the number of discriminatory businesses. And to do that, we look at the census of business, and we take by county the counts of the other businesses in the same category. And then we subtract the number that are listed in the green books to come up with the number that are discriminatory. What we add in this analysis that was not available in the draft before is we have eating and drinking places and we have gas stations as well. One of the problems with eating and drinking places and gas stations, however, although the results are consistent with what we get for hotels, is that it's important to understand that the segregation environment for eating and drinking places and the segregation environment for hotels was in fact quite different. Hotels discriminated at the extensive margin. In other words, African Americans could not solicit those businesses. Gas stations and eating and drinking establishments could discriminate at the extensive margin, but were much more likely to discriminate at the intensive margin. In other words, the restaurant would not serve an African American patron inside of the restaurant, but they could have, for example, food to go. A gas station might allow African Americans to purchase gas, but would not allow them to use the restroom. And so it's more difficult to think about that discrimination environment because of this intensive margin discrimination at the time. So when we look at these numbers of trends over time, I won't go through these charts except to say that the broad trends of the businesses are actually quite consistent. And we do see that the green books are positively correlated with evidence of discrimination and also with economic factors such as real wage rate. If we look at the number of green books per capita, we find that there actually is a stronger correlation with, for example, political Black activism by the number of NAACP chapters, and also a negative correlation with the number of lynchings and Confederate symbols. Discrimination as coded in the green books is also related to the number of establishments. So here we take is Pauli Murray's laws of race and color and look at anti-discrimination and discrimination laws. And we find that the presence of these non-discriminatory establishments is positively correlated with anti-discrimination laws and negatively correlated with discrimination laws. So at a broad level, what this really is capturing is something about the legal environment and the political environment with respect to segregation. And now moving to the market conditions hypothesis. So we take that green book data and we add to it data from World War II casualties. This was digitized and matched by Ferrara, and it's available by race, by skill level, and at the county level. And so this is the casualties and the number of white casualties in each county that we're able to calculate from those rolls. We also have a variety of county level controls, including Black migration, World War II contracts, measures of residential segregation, lynchings, Confederate symbols, religiosity, etc. So what we're doing in this empirical approach is we're exploiting an exogenous change in the number of white consumers. Racial segregation in the military meant that whites had proportionally higher enlistment and higher combat assignments, and therefore higher levels of mortality in the war. So in this difference in difference, what we're doing is we're comparing changes in the number of Green Book establishments over time and across counties with varying levels of white casualties. And this is a well-used instrument in the literature. So it's a standard difference in difference, and it's a dosing framework of a difference in difference. We're looking at the number of casualties after the Second World War and its relationship to the number of Green Book establishments. So the underlying assumptions here are that the Green Book and changes in the Green Books must reflect changes in public accommodations and not merely selection. And we do have balance in these variables. The second would be there are no anticipation effects, that the Green Book establishment should not have been increasing in expectation with white mortality in the Second World War. And of course, then there's the parallel trends assumption that in the absence of World War II, counties would have experienced the same growth in Green Book establishments. And we do this with a very simple event study analysis. And we're able to show that even when we include 1938, that the Green Book establishments did not appear to grow more in areas that had high mortality before the Second World War as they did after the Second World War. So these are our baseline difference in difference results. And so for every 100 white deaths after the Second World War, we see that there are about 1.4 more Green Book establishments in the county. We can show that these results are not a function and driven by the areas that have the highest levels of white casualties. So we trim the results. And to explain this in more detail, this 5 here at the top and bottom percentile means that we've excluded the top 5% of casualties and the bottom 5% of casualties. So we've excluded 10% of the data. And we still see a significant and positive relationship with mortality, casualties, and the number of Green Book establishments. Another way that we can think about this is breaking this down by different types of businesses. And here we have a placebo result. As I said earlier, the informal accommodations are people opening up their homes to travelers. And that is not sensitive to white casualties, where we do see a result for formal accommodations, which are formal businesses open up to the public. So the area that we would think will be less sensitive to changes in the white consumer market is not reactive at all to white mortality at this time as induced by the Second World War. Another is we look at sort of the effects and the number of establishments at the intensive and extensive margin. And so what we find is that this does not have an impact on just geographically spreading out the number of places that had Green Books. In fact, the action is in places that had Green Books before, Green Book locations before the Second World War. And if we look at these industry shares, we see a similar sort of ratio when we're looking at hotels and eating places, as we do with gas stations as well. Again, we think that the results for hotels are more reliable than for the other businesses, but they're largely the same when we look back over these. So that shows that if we have places that have higher levels of white casualties, we see more non-discriminatory businesses. That does not tell us necessarily that we're moving into and telling anything about consumer discrimination. So we have a model where we're trying to capture this equilibrium relationship between a firm's decision to discriminate and consumer preferences for discrimination. So in the model, in its sketch of it, the firms are choosing whether to enter a segregated or a non-segregated market. They set prices and then consumers make their purchases. Black consumers are restricted to purchasing from the segregated market, and white consumers choose which market to buy from. And some of them are going to have discriminatory preferences and not going to want to shop alongside Black consumers. So the bottom line of this is that the ratio of non-discriminatory to discriminatory firms moves with the ratio of Black and white consumers, right? And that's pretty intuitive that if you're in a place that is exclusively African-American, it might not be the best to have a racially discriminatory business in that location. So empirically, what we're looking at is this firm ratio as a function of the Black-white consumer ratio. Now, we're ignoring changes in the discriminatory environment that may affect the number of non-discriminatory consumers. The literature suggests that preferences for discrimination are pretty stable. And endogenous population change is actually the key threat, right? So what we would see is African-American consumers would likely move away from locations that have few public accommodations that are non-discriminatory and move towards locations that have more non-discriminatory businesses. And similarly, whites with strong discriminatory preferences will move away from places that have non-discriminatory businesses to places that have few non-discriminatory businesses. So in this case, what we need is an instrument for the consumer ratio that is not, and that is overcoming this endogenous population change that would be right committed with and correlated with the firm ratio. So using the firm ratio requires that we actually restrict ourselves to counties in the census of business. But what we're doing here is we're taking in the first stage, the Black-white ratio, and instrumenting it with the casualties from the Second World War. And in the second stage, using the firm ratio and looking at its relationship with the Black-white consumer ratio. And what we've done is we've isolated the channel through which the consumer preferences would have an effect. So in other words, these are places that are losing white consumers, and the effect of the losing white consumers on the prevalence of non-discriminatory businesses is what we're trying to capture. We're directly isolating the mechanism through which white casualties impact the growth of Green Book establishments. So are hotels actually the right sort of business, right? Hotels, as listed in the Green Books, do tell us a lot of information, as I was showing you earlier, that the best comprehensive source of non-discriminatory businesses nationwide for hotels. And discrimination in hotels took place at the extensive margin. Because of that, the hotels might actually provide a lower bound for the market conditions hypothesis. Empirically, we see that the number of hotels is proportional to the local population. The market composition of travelers is proportional to the market composition of local residents. And we're able to show in the paper that it is not the case that Black consumers in national surveys were less likely to travel or less likely to travel long distances relative to other consumers. So when we're looking at this as sort of a first stage for the results, it is the case that the Black-white consumer ratio is increasing in areas that have higher white casualties, and that the change in the Black-white ratio is positively related to the number of casualties in the Second World War. And this is both for the market and also the market and its neighboring counties. So when we move to the IV results, where we're instrumenting the Black-white consumer ratio now with these casualties, we see this large effect. And this particular, so in column 6, where we're showing the instrumental variable results, is where we see that the change in the Black-white consumer ratio as instrumented by casualties is related to the change in the non-discriminatory to discriminatory to non-discriminatory firm ratio. And this is where we get a 1% change in the Black-white consumer ratio leads to a 2% change in the discriminatory to non-discriminatory firm ratio. We can show these results for other industries. We can show them here. We show that they work for example, for gas stations and eating establishments, and the point estimates agree largely with the others. And so we do see that this does have some effects, and we can trim the results, etc. And we see the results that can work by own and neighboring locations. But I want to show this result in particular by firms. If we're thinking about this discriminatory hypothesis here that we're talking about, this actually has more traction in areas where the firm faces fewer competitors. Right? Thinking back to Wright's discussion of what the firms are saying, they're worried about defection of white consumers. And here what we find is you see the most action and the largest response of firms to serving this non-discriminatory market when they have fewer competitors. Right? So all of the action that we see here comes in firms that are in the bottom third of the competitive distribution. In other words, they face the most, they have the most monopoly power in this distribution. It's part of the distribution. They're the most likely to integrate because they can essentially tie the hands of their white consumers while also seeing gains from serving Black consumers. We do a number of checks for alternative explanations in terms of changes in the attitudes of white veterans, Black political involvement, and changes in the economic conditions of Black Americans. I won't go through all of these, but just to show that we control for the number and changes in the number of NAACP branches, that does not have an effect. We see that changes in the percent of Blacks employed and occupational rank do not overturn the results either. And so we think that they're unlikely to be explanations. If we're looking at potential for occupational upgrading to be this result, we can look at these casualties by type, and we find that only in this amorphous service category do we see an effect. So it's not as if it's just an increase in the number of Black professionals that's driving this, this result. So overall, what we're able to show is that constructing this new national data set of non-discriminatory firms, we can describe the evolution of access to non-discriminatory public accommodations across the United States before the Civil Rights Act of 1964. And we see that we're looking for consumer discrimination playing a very large role here, and we do. It is necessary that we have a 1964 Civil Rights Act which bans discrimination in public accommodations, because the market forces were not going to make that so in terms of nationalizing or establishing a practice of non-discrimination nationwide. Our results point to the fact that you would need several world wars worth of casualties or changes to the white consumer distribution to have non-discrimination in public accommodations nationwide. And it suggests that these market conditions, while they were present, are simply insufficient to drastically increase access to non-discrimination in public accommodations nationwide.
All right, thank you. Your discussant is Dan Arison, and you'll have about 10 minutes.
Okay, thank you. Is my slide up?
It's kind of up, but it's covered by a window.
Oh, yeah. How about now? Is that better?
Yeah, you can also sometimes just share one window, but or maybe
well,
make
you know
that.
what? My slides are not critical, so let me just plow ahead. So thanks for inviting me. This is. I'm thrilled to be assigned this paper. It's really, really beautiful. I sincerely wish I had written it myself. I have, very few qualms. So I'm going to really spend my 10 minutes describing why I like it and why I think it's really still quite relevant for today. So to start, what I especially like about this paper is it's keying in on several fronts that I think are really understudied in economic history and economics in general. And Trayvon can correct me here, but my impression is that despite the fact that it's like unquestionably important, the civil rights movement, and I have this, if you can see my slides, I have this paraphrased quote from a friend of mine who said the civil rights movement is to political scientists what the Great Depression is to economists. Yet, despite how important this was, there's very little empirical focus on the economic factors that caused it to arise when it did, and why it took so long, and which institutions helped and hindered it along the way. Most of the work in this area is outside of economics, and so it's quite descriptive in nature. And so this paper is, adding to a very small literature that's trying to provide some causal punch to explain some of this really important activity. So, like if a decade ago, I might have even gone further and generalized this to say that there aren't a lot of causal studies of the role of discriminatory policies and institutions in this early 20th century in general, but that's been changing for the better. And I threw up a couple of examples of this, but since this is a Minneapolis Fed conference, let me particularly highlight work that's being done on mapping racial covenants in Minneapolis by some people at the University of Minnesota, which has been really extraordinary. In fact, they're now trying to do the same thing in Chicago. So of course, there's this long history of looking at discrimination in schools, but outside of that, in labor markets, a little bit, but not in the kind of identification way that we think about now. That's starting to change, but especially in housing markets, there's a lot of really good work going on right now. But despite its destructive impact and its historical importance that Trayvon described, there's really nothing on the role of public and private retail segregation. And the other thing that I really like about this paper is it's focusing on firm behavior. And that's also really rare, even though there's some really famous examples of firms that kind of, that made progress in different ways on this front. So a really famous example of this, ironically enough, is the Ford Motor Company, which introduced race-neutral wage-setting policies in the 1940s, despite its previous history, I guess, or at least the CEO. And so there's a really nice paper by Lanning and Reynolds, and what Trayvon just said about the importance of competition here really applies to that Ford example as well, since they were essentially a monopoly hiring in the labor market in Southeast Michigan at the time. And then I have to mention that historians and proud Chicagoans also like to point out the Pullman Train Company also was a really important progressive player in trying to move African American families into the middle class much earlier on. Although we don't know a lot about that. I hope that's going to change. So what do they do? I'm going to flip slides. Maybe you can see this. So first, they study where the Green Book establishments popped up, and this is this is a real bread and butter kind of exercise when you're studying new institutions. But they have this really nice twist that they can say something a little more causal because they're using the exogenous shocks due to the mortality of white World War II veterans to proxy for local population shocks at the county level. So this is really clever. It's very intuitive. It's also extremely novel, partly because this data is brand new. It was only transcribed very recently. And they get some super interesting results that pop out. But the one that really intrigued me was that the growth is all on the intensive margin. In particular, counties with a green book that had a green book place already established prior to World War II were the ones that saw all the growth afterwards. And that raises some really important questions about the relative progress of the areas that were kind of left behind, and particularly for its residents and migration patterns and so forth. Also, another thing that's kind of going off on the side here that's too much for this paper, but there's also big changes in access to human capital during this period, and that it would be very interesting to know a little bit more how that plays into this narrative, especially white education levels and how that matters for how these things popped up. So Trayvon has this nice result that shows that this is not being confounded by income gains. Maybe that's true of education too, but keep in mind that education and income gains happened at different times. In particular, it happened earlier for education than income, and so it'd be kind of interesting to see how that matters. As a side note, I'm glad he brought up the NAACP, which also is a potentially confounding factor because their concern basically is there's lots of grassroots political participation that's starting to pop up in the late 30s and 40s. And in particular, there's an exponential growth in NAACP branch activity during this period. But there's a couple reasons why I'm not surprised that the NAACP doesn't matter here. One is that they weren't really a powerhouse on the ground locally. And I'm probably getting myself in a little trouble here, but there's a lot of tension at this time between local leaders like Ella Barker and the national office, which is pretty much exclusively pushing legislative and legal action. And so in many ways, the branches are really just a function of raising money for these really critical efforts that are going on in New York and Washington. So it's an open question, what's going on at the local level. But my understanding is that, one of the reasons why the NAACP winds up peeling off from other civil rights organizations in the late 50s is this conflict between how much local organizing is going to matter. But I mention this because I don't want to dismiss the role of the NAACP, which was the preeminent organization here. That it's just you might not pick it up in the cross section, the geographic cross section, but it might be really critical for the secular trends here, which is not how the identification is being picked up. So the rest of the paper is basically what they do is they write down a tractable theoretical model, and they get this really nice clean test of why green books might have expanded when they did and where they did. Cutting to the chase, it's the ratio of discriminatory to non-discriminatory firms as a function of the ratio of the race of consumers. And then they test this, and it's super intuitive. And by the way, this kind of test has shown up in a lot of papers in the past. It's just often the outcomes are a little different. Sometimes people look at employment. When they have it, they look at sales, prices, and so forth. They're focusing on the hotel industry, which has some pros and cons. One pro is they don't have to worry about endogenous migration, I guess, because consumers are travelers. But I do struggle a little bit with the concept of using locals as consumers of accommodations and what the right measure would actually be. Maybe the IV, this is sort of a measurement error problem, so maybe the IV kind of fixes this anyways. But it makes me a little concerned about complicating the interpretation of customer discrimination relative to, say, employee or employer discrimination. But maybe that's not super crucial anyways. So anyways, and one other thing I wanted to mention was, this is probably a little much for this paper, but it feels like the Great Migration might be a useful test here, as another natural experiment. Obviously, migration is literally the point of the Great Migration, which complicates the econometrics. But I can imagine doing something clever with the exogeneity of specific train routes, like Dan Black and his co-authors do. And the reason why I bring this up because it potentially, there'd be effects on both sides of the train route. One side's losing Black residents, the other side's gaining them, and it might be interesting to see how that all works out. So with whatever time I have left, I just want to emphasize that why you should care about this stuff. So first of all, this has been already talked about. This is just another arrow to try to understand the origins of black-white gaps. But I think some of this may still be going on. There have been a few papers recently that have looked specifically at customer discrimination. The results are a little bit mixed, and they tend to be stronger outside the US in the studies that I've seen, one in France and one in Israel. But I do want to show you one set of results that I think is very much related to this. So this is way too complicated to describe, but basically the gist of this is over the last few years, there have been many localities that have been raising their minimum wage with hikes much larger than we've seen in the past. And at the same time, these hikes have led to a reallocation of jobs away from routine jobs and towards interpersonal related jobs. So interpersonal being very customer focused jobs. Okay, so this is very consistent with automation when labor costs go up. So at the chart on the left, what this is showing basically are employment elasticities 2 years after a minimum wage hike, and they're split on the left-hand panel. This is for routine share. The blue bar is for minorities, and the red bar is for non-minorities. And so what you see after a minimum wage hike is routine share employment goes down. It's bigger for minorities than non-minorities, but everybody's kind of losing some of these types of jobs. Then if you go over to the right panel and just focus on the oval version of the oval column, what this is showing is that after these hikes, a lot of these jobs that are being lost, these routine jobs that are being lost, are being replaced by interpersonal jobs, at least for the non-minority sample. So this red bar is roughly offsetting this red bar here, and you get basically a zero employment effect. But if you look at the minority sample, that isn't happening. That hasn't been happening for the last decade. And this is sort of new. If you go back pre-financial crisis, there isn't really big differences between minority and non-minorities. So as a result, we're actually starting to see, after minimum wage hikes, we're starting to see employment losses among low-wage minority workers. So a big question is why this is happening. And again, I want to focus on this interpersonal thing because this is the customer-focused part of the paper. So another thing that's been going on that political scientists have been writing about is that racial resentment has been going up throughout the country. And so this is one version of it on the right panel that's calculated by state. Okay, I'm almost done. The reason why I'm throwing this up is just to emphasize that there is geographic variation in the amount of racial resentment that has been increasing over the last couple of decades. So, okay, so some people can't see the slides. Sorry about that. It turns out the bottom line is this effect that we're finding on interpersonal share for minorities versus non-minorities, this racial disparity, it's all showing up in states that are seeing increases in racial resentment. Okay, so I don't want to put this result on the same pedestal as Trayvon's at all, but I bring it up to highlight that these issues related to customer discrimination could potentially be explaining a lot of this. And so this customer discrimination story is not just a relic of the past, but maybe something that's still affecting low-wage labor markets today. And so it's just another reason why this is really so relevant. So I will leave it at that. I apologize that my slides probably got screwed up.
All right, thanks. So we have some questions, but Trayvon, if you want to take just about a minute or two to respond to anything from Dan. I know he had a lot of stuff there that was very interesting.
Yeah, I think that this is great. I really sincerely appreciate that discussion. I really enjoyed it. I think two issues I think that I will speak to in this brief time is we would love to use the Great Migration as an instrument. It comes a little bit too early because we start in 36. And so the Depression is what ends the first wave of the Great Migration. So we could think about it in terms of subsequent flows, but the Second World War also led to a lot of sorting, which is another reason why we want to use the casualties as an instrument, because there's just so much going on in terms of population shifts after that point. But it's a really good point about where do we see more businesses? Are they places that are sending locations or receiving locations would be another sort of just even as a descriptive fact, which would be sort of interesting to document. In terms of the hotels and thinking about hotels and consumers, what's really interesting, we probably need to build more of this into the narrative of the paper, is that hotels discriminated even though they serve national markets because of these local discriminatory preferences. They always viewed themselves as being, guests in the local community. And those are the preferences that sort of guided how they would treat even people who are traveling from without. And there's a great deal of appeasement of these discriminatory preferences that hotels end up representing, that again, I think we should do a better job in the paper of really detailing how that actually operated.
Great, and so we have a couple of questions. So Belinda was asking a question about whether or not your results can be viewed as support for Becker's theory of discrimination. And this was very related to some other questions that arose of whether you can use your model to kind of measure what sort of distortions that Becker theory is providing to production in your model, basically.
Yeah, so in our model, we are assuming that the firms have non-discriminatory preferences, right? They are just agnostic about racial discrimination, and the discrimination is from consumers. And so, Becker's model of discrimination, when you go to consumer discrimination, remember the result is that discrimination is an equilibrium outcome, and it's actually a stable equilibrium outcome. So there isn't, in our traditional economics of discrimination, Becker models, discrimination is bid away by the market process because the wage bill and the discriminating firm is paying too much for these workers, and their profits are going to be lower than the firm who's not discriminating. And in a consumer discrimination model, the firm should discriminate because the consumer is willing to pay for discrimination, right? So they would have less profit, which is exactly what the consumers are saying in rights analysis. So it would be more complicated to think about the firm owners themselves having discriminatory preferences, but that's not what we're testing here. So we do confirm that there are strong preferences for consumer discrimination, and that firms are meeting those preferences for their customers. But that's also another point I think that Dan is talking about. Bruce Weinberg had that paper some years ago, People, about these customer-facing occupations that tended to have very skewed demographics relative to the skill base in the market, and also into the demographic compositions there. So I think that there is some more scope, and I just think there needs to be more work about consumer discrimination. It just isn't where sort of the applied micro toolkit has been best used so far.
I also wanted to ask a question. I thought that the point that you were able to make in your paper looking at market share or market power of the various establishments was really unique, and that might have some perspective on current events and issues going further. So could you kind of reiterate the results that you found on the role of market power and what sort of role these companies might play in these situations?
We came to that thinking back to the Civil Rights Act of 1964 is a really interesting thing. It is signed by President Johnson in July, and the Supreme Court makes a decision about the public accommodations Title II part of the act in October, right? So it immediately goes to the Supreme Court. It is the most contentious part of this. And one of the things that they note is that the hotels in these southern cities like Houston and Atlanta and Dallas, et cetera, immediately after the passage of the act started booking national conventions that they had not been able to book before because they were discriminatory and national organizations did not meet there. If you go back through the notes and we looked at for the American Economic Association, they curiously avoided southern cities for many, 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 many years, particularly during this time in which the southern cities would have had discriminatory hotel practices. And they asked this question of why, the Supreme Court asked, why is it that all of these hotels are just leaving all of this money on the table? And when you think about a downtown establishment, a downtown and downtown hotels, there are multiple hotels, and none of them wanted to be the first mover to provide non-discriminatory services because then all the other hotels that would continue to discriminate would, they believed, earn more money. And so they're making a calculation of how much money they're going to gain, for example, by booking national conventions, as opposed to how much money they're going to lose by not booking weddings and the other sorts of things that hotels are doing for their consumer base. And so this led us to think about the fact that, well, if you're in a smaller town, you might be the only hotel in town. And if you are, then you might be more likely to see nothing but an upside, right, from serving African-American customers, because your white customers have nowhere to go. And that's what gave us this idea that, you know, firms actually were able to use their monopoly power to now, in the evidence of these population shifts, begin to provide non-discriminatory services because they were less afraid of the competitive motives of the other firms in the market continuing to practice discrimination and receiving a lot of customers as a result of that.
Thank you so much, especially for that particular comment. We have lots of modelers in the audience, and I think that that's an interesting difference from a typical competitive model like you were talking about with Becker. So we'll move on to our final paper because we are staying on schedule here. And this will be Anya Klemenova. You are presenting the life cycle of a bank enforcement action and its impact on minority lending. So we'll start you off with 20 minutes. Thank you.
Thank you. Just click on the full screen so you can see it. All right. Well, thank you very much to the organizers for having this paper on the program. And also, we're very grateful to Luigi for being our discussant. We're looking forward to your comments and suggestions. Hopefully you'll get a chance to kind of add your comments as we're trying to revise the paper. This is joint work with Byung-Chun An, who is a PhD student at University of Utah, with Robert Bushman and Remy Tommy Bushman. Robert Bushman is University of North Carolina, and Remy is at Chicago Booth. The usual disclaimer applies. These are our own views and not the views of the Federal Reserve Board or the Federal Reserve System. So the big question that we're after in this paper, and sort of as being the running theme of this conference, is trying to understand what impacts lending, in particular this lending to minorities, how can we potentially avoid certain types of discrimination. And here we're taking a slightly different approach. We're trying to understand whether the supervisory enforcement mechanism that we have in prudential regulation of financial institutions might play a role in changing the way that banks lend, in particular, whether the enforcement mechanism by itself might change the actual distribution of borrowers and the borrower base that banks lend to. We've been discussing here why kind of home ownership is important. A number of papers has already mentioned this. Home ownership provides very important intergenerational wealth transfers. It affects the wealth gap between the whites and minorities. We know that children of homeowners have high educational attainment and lower likelihood of incarceration. So achieving home ownership plays an important role. We know that the way to do this, especially in the United States, is through residential mortgage lending. And those loans are provided by banks as well as shadow banks. And over time, some research has shown that looking at algorithmic lending, for example, has reduced some sort of disparity, some discrimination in lending. However, it still persists in certain ways. And what we're trying to draw attention to is, well, we have banks who are in this market who are lending to minority borrowers, and they are subject to prudential regulation, while shadow banks are not. So is there something that's specific to prudential regulation that might affect the way that banks lend? And in particular, we're after the following research question is, what the bank regulators and supervisors play a role in shaping the way banks lend and the lending decisions they make when they lend to minority borrowers. Sort of the overarching research question is, does supervised enforcement actions or supervised enforcement process affect the way banks lend to their borrower base? And in particular, we want to understand whether through the process of enforcement, banks change their behavior during the time when they're subject to an enforcement action, which I'll define in the next slide. We want to understand whether they change their portfolio location, in particular, whether they change who they lend to. And then we will try to explain what is the underlying mechanism driving these results. Let me just define what enforcement actions are in case you're not familiar with them. They are part of the prudential regulation that we have in the United States. They're called enforcement decisions and orders. In our paper, we call them EDOs. They have been issued since 1966. They've been publicly disclosed after Ferrer since 1989. In this paper, we are focusing on the period of time when everything is publicly disclosed. So banks know if they're subject to supervised enforcement actions, so do their competitors. The supervised enforcement actions, the EDOs, represent the measure of last resort. Usually they're issued at the end of the process of discussion and negotiation between the bank's supervisory team and bank's management. And the reason why they will be issued is to make sure that banks take certain corrective actions. In particular, they might need to change the way they lend, they might need to increase capital. And within that, we focus on the most severe types that require taking those actions or otherwise will carry very severe penalties. In particular, we look at cease and desist orders, formal supervisory agreements, consent orders, and prompt corrective actions, so PCAs. What kind of penalties would these severe enforcement actions invite? Banks might lose their charter, their license, or their insurance. And PCAs in particular look at when banks have low capital. So these are the enforcement actions, and they are quite disruptive to banks because they might require banks to cut risky lending, change their management, increase capital and provisions, or improve their internal controls. We have also seen in other research as well, as in the paper that Remy and I have, that the process of enforcement actions, particularly the public disclosure, results in a reaction from depositors. And so there's a decline in deposits that also then has a corresponding decline in banks' ability to lend. So when deposits go down, so does the ability to lend as well. So as a result of the enforcement actions, banks could also be subject to additional regulatory oversight. So this is where we are heading with this. In particular, why would we think that enforcement actions could change the way that banks lend, and in particular, why would it affect their borrower base? Well, one thing that enforcement actions could do is they can directly address some issues that deal with violations of fair lending laws. Actually, when we look in the text of the enforcement actions, we don't find many examples of those enforcement actions, but there could be an auxiliary portion of it where banks are required to change the way they lend, they change their procedures, and that might result in banks' ability to actually lend to a wider group of borrowers. It is also possible that competition from other banks that observe that banks subject to an enforcement action has received it might invite these banks to kind of steal away the potential customers. And so as a result, the EDO bank has to reach out to a wider group of borrowers and ends up entering the market with underserved borrowers. It is also possible that banks might have incentives to cater to their regulators once they're subject to an enforcement action, in particular to gain future leniency, or maybe manage their capital because residential mortgages have lower capital charges than, say, unsecured lending. Let me summarize our key findings before I go through more details in the paper. What we find is that banks subject to enforcement actions end up changing their lending to minorities. In particular, they allocate a higher portion of their portfolio shares within their residential mortgage lending to minority borrowers. And they also expand their market shares in the counties where they lend. So relative to lending to minorities by all banks in a given county, we see an increase from EDO banks. Not only that, EDO banks also expand their geographic presence. So they lend in more counties and they lend to minorities in more counties as well. Not only that, they also deny fewer applications from minority borrowers, and they're less likely to rely on non-price terms such as credit history. And one important caveat here is that what we do find that while we find the banks increase lending to minorities, the loans that they are less likely to deny applications for are for existing customers, such as loans for refinancing, for investment properties, and home improvement loans, rather than home purchase loans. There is an improvement in home purchase loans, but it's not as significant as the rest. In terms of what might be the driver of this results, we find that the improvement as part of the enforcement actions in banks' ability to lend, as well as potential catering to gain future leniency, are the incentives that lead banks to increase lending to underserved borrowers. In particular, we find our results are stronger for banks with stricter regulators, the ones that spend more time being subject to an enforcement action, we call the severe enforcement actions, as well as banks that start with having lower CRA ratings. We do not find much support for the competition channel. We don't find the banks expand lending to borrowers that are riskier. And we also do not find that evidence that banks end up lending more to minorities because they're trying to manage their capital ratios. I'm not going to go much into depth of the literature that we build on, but what we're trying to do is connect three main strands of the literature, connecting the enforcement being part of the market discipline, as well as having spillover effects on other banks, and branch it into a wide literature on the documented discrimination in lending, in particular in residential mortgage lending. And what we're trying to do is bring this together and kind of provide some explanation of why we might see changes in lending to minorities. In our analysis, we rely on several data sets. In particular, we identify banks' enforcement actions using SNL financial data. We have call reports and we focus on commercial banks. An average size of our bank is sort of the size of a community bank, about 150 million total assets. We use the summary of deposits data because it allows us to drill down to deposits at the local market level, which we define as a county. We also rely on the HMDA data for mortgage loans because it allows us, again, to get transaction level data at the county level. Not only that, HMDA after the Ferreira Act also collects information on lending to minorities. We define minorities as they're defined in Ferreira as well as in HMDA, and they're defined by race. So American, Indian, Alaska Native, Asian, Black, or African American, Native Hawaiian, other Pacific Islander are all going to be minorities in our study, and sort of whites are going to be non-minorities. We focus on the most severe enforcement actions, as I already mentioned. We have a sample that goes from 1994 to 2018, and we cover about 1,350 unique severe enforcement actions. They're spread geographically and in time, and this map here just kind of is showing you that we don't have clustering in particular areas. Enforcement actions do exist throughout the United States. And this is an important picture to keep in mind because we will be drilling it down to local markets, defining them at the level of county, and we have to have enough enforcement actions across the United States to use that for our identification. We cover about 99% of all the counties that are covered in the HMDA, which is important for our mortgage lending results, and about 60% of what is covered in the summary of deposits data. Let me also summarize first a few concerns that we have regarding research design and what we do to mitigate this. As you might be thinking now, well, these are regulatory interventions. They're not happening in a vacuum. They will be correlated with local economic conditions, and banks that get enforcement actions also must be bad enough banks. However, there are ways that we can address this concern. We'd make certain research design choices that help us get there somewhat. In particular, we focus on the local markets just to account for local market conditions and local demand for loans. We also rely on the transactional level data from HMDA to, again, focus our analysis on those local markets. We look specifically at EDO banks to avoid capturing any spillover effects that might be happening to other banks operating in the same market that might be learning about EDOs or might be similar. And to address the concern that, well, maybe you're missing something about what's happening in local market, we also do calculate market shares to capture the aggregate local market effects in a given county. We have done placebo tests just to make sure that we're not capturing something that's very specific. We use the random sample as well as sample of banks that are matched on the size and geography, with geography again being the county. Let me move kind of now to our analysis. So we'll first start by looking at what happens to banks' deposits. I already mentioned to you, enforcement actions are quite disruptive, so you would expect that if depositors learn about it, they will decrease their deposits. This is exactly what we find when we look at deposits, but let me summarize kind of the type of research design that we use here. During EDO is the actual time a bank spends subject to enforcement action, while post-EDO is 5 years afterwards. And here we also control for bank-specific characteristics such as size, profitability, and county-specific characteristics such as employment growth. Here in the first set of results, you see that deposits decline once we control for bank-specific effects, and they decline by about 1.6% within a county. Not only that, banks' deposit shares in those counties also decline. So if deposits decline, you would expect to see an impact on the loan portfolio as well. So in the next set of analysis with similar research design, we'll look at what happens to banks' portfolios at the level of the bank, because that's the data availability. Here you see total lending and the portfolio broken down relative to total assets. Since deposits decline, you wouldn't be surprised to see that total lending declines as well. And when we look at the portfolio, here we find a surprising result, which is while C&I lending, mortgages, and CRE lending declines, when we look at residential mortgages, we actually see that relative to the pre-enforcement action period, which is 3 years before banks receive an enforcement action, we don't actually see any significant changes. So given that residential mortgages don't decline, we wanted to understand what drives this change. And so this is the rest of our paper is focusing on what happens to the mortgage lending market. Again, we focus on the commercial banks. They do issue a lot of mortgages. About half of their mortgage portfolio is in residential mortgages. HMDA gives us a granular data, and it allows us to address some of the concerns about and answer potentially questions about the frictions that exist in the mortgage market, in particular discrimination in lending. So I already summarized in the results. One of the first things that we see is banks, after they exit the enforcement action successfully, they end up expanding the number of counties to which they lend. If you see the 3 years and the pre-period, the average number of counties that our banks lend is about 22. However, after banks exit enforcement action, they expand their lending to up to 31 counties, but not only that, they expand the number of counties in which to lend to minorities. But note that they don't necessarily go into counties where the majority population is a minority. So next, we're going to see what happens with the portfolio allocation as well as market shares in residential mortgage lending, specifically to minorities as we've defined it. Now it's going to be county level analysis. Here, because there are a lot of counties where banks don't lend to minorities, as you saw was the first table, we're using research design that relies on the random effect Stobit, just to take into account the fact that we have a lot of zeros in our portfolio shares and market shares. So here, the important result is that when you think about the reallocation within residential mortgage portfolio, what we observe is that banks increase their lending to minorities, the allocation of their portfolio of lending to minorities in their residential mortgage portfolio by about 2.5 to 6%, which is an economically significant increase. We also see that banks gain market shares in those markets. So in the counties where they operate and lend to minorities, they gain market share, again, a significant economic result. So where some of this might be coming from. Next, we will investigate whether banks change the way that they review applications. In particular, we're going to look at the denial rates. And here it's a multinomial logit analysis. The first column summarizes the main characteristics of denials, and you see that minority borrowers in our sample, on average, are 11% more likely to be rejected a mortgage application than a white borrower. However, following their successful exit from the enforcement action, banks actually reduced this by about 6.4%. So minorities are less likely to be rejected for a loan application. But where is this result coming from? Well, it's coming from a decrease in denial rates for refinancing, mostly, as well as home improvement and non-occupied purchases, so investment properties. So these are known borrowers to banks. 1.8% of it still comes from mortgages that are for unoccupied property. So there is some improvement in lending to minorities. We also noticed that most of this decline is coming from the fact that banks are less likely to rely on non-price terms that have been documented in prior studies as a way that banks can use to ration credit, in particular to minorities. Here, they're less likely to rely on credit history, and they're also less likely to provide the category of other kind of reasons for why they're denying a mortgage application. So why would lending to minorities change? Well, enforcement actions could be addressing certain issues. They could actually make a bank better, and the structural changes might lead a bank to realize that they were denying applications that they should have been able to take. It's also possible that the changes in regulatory regime, having stricter regulators and having longer enforcement actions might result in some improvements through the enforcement mechanism that leads banks to lend to minorities. So that's one potential mechanism. Another one is basically compliance and appearance. These are community banks, and it's possible that if they are viewing this lending to minorities as something that their regulator would prefer, they might be increasing lending as a result of it. There could be also a change in competition. Let me quickly go through this result, as I think I'm nearly out of time. What we find is that most of our findings are driven by stricter regulators and banks subject to enforcement actions that take longer, not by their capital management. So it's not that they manage capital, they are trying to appeal to their regulators. And in particular, when we look at banks that have low CRA ratings, which is the Community Investment Act ratings, that specifically look at banks lending to minority borrowers and underserved communities, we find that banks that started off with having low CRA ratings, but not necessarily receiving enforcement actions for this, they started with lower CRA ratings, they're more likely to improve following enforcement action by lending more to minorities. We do a number of additional analysis. In particular, we don't find that banks lend to riskier borrowers. We don't find that securitization drives these results. We don't find any significant results for competition, but what we do find as well is that when we look at solo mortgage borrowers being women, which also have been discriminated against in the past, we also see that these banks improve their lending to this particular group of borrowers as well. Let me conclude just to summarize our main findings is that in this paper, what we try to do is to explore the impact that supervision enforcement process has on on banks, and in particular see maybe there is a spillover effect from enforcement on the way that banks lend. And we find some evidence consistent with improvements, as well as bank catering to regulators to gain future leniency. While we do find some positive results, I do caution you with interpretation, because we do find that most of the increase in lending to minorities is not coming from minority getting more access to their home ownership, because that's not the main finding. Thank you very much for your attention. I look forward to your questions, comments and suggestions, and to Luigi's discussion. Thank you.
Well, Luigi, you're all set.
Okay, so first of all, thank you very much for giving me the opportunity to discuss this very interesting paper in a super interesting topic. So you can see my slides okay, right?
Yes, we can see your slides.
Okay, fantastic. So I actually very interesting in the topic of enforcement and minority lending. And so I will start with a question, and I promise that I will offer a drink to everybody who answered the question correctly. Who is the only bank prosecuted for mortgage fraud after the 2008 financial crisis? And I give you time to, in the chat, respond. The answer is actually Abacus Bank, nothing to do with Abacus of Goldman, is Abacus Bank, and actually it happens to be a minority bank located in New York. And what happened, and this is thanks to an undergraduate of mine who did a dissertation on this, is that the level of loans by Abacus dropped tremendously, and what you are penalizing massively Asian American who were natural customer. Now, as it turned out, all accusations were dismissed, so there was no reason, and as a result, a lot of Asian Americans were made worse off when actually people who did mortgage fraud went away happily around the country. So this paper is not about federal prosecution, it's about actually prosecution by the bank regulator, either the Fed or the state regulator. But it is similar in so much as look at the impact of this enforcement decision and orders on minority lending. But it finds actually the opposite result. It does lead to an increase in minority lending, and in spite of the fact that every other lending goes down. So I think that this paper is a bit misfocused, because if you look at the abstract, they say the paper studies the role banking supervision plays in improving access to credit for minorities by doing enforcement action. Now, actually, what they look is a bit of the collateral damage or collateral benefits, because one of the tasks of enforcement is to ensure compliance with the FHA, the ECO, and the Community Investment Act. However, as they report, of the 1,147 EDOS enforcement, only 12 were for violation of any anti-discrimination laws. So if we ask the question, what enforcement, banking supervision enforcement does to improve access to minorities, the very simple answer is nothing. Okay, so de facto, directly, they don't do anything. And I think the paper should emphasize that, because that's a pretty actually damning piece of evidence that I've never seen before. So in that sense, is a very useful contribution of the paper. Now, the paper does not do that. It looks more at what I consider unintended effect, is a bit like if I get criminally indicted, probably I behave very well in every dimension, including moving my loan. That's a collateral effect, and maybe it's because I'm catering to the bank regulator, as the author said. But I think that maybe is more a kissing of the ring. But I think that there is another hypothesis, is that maybe, given that there is no enforcement for CRA and other equal lending statutes, then every bank in the sample regularly discriminate. And banking regulators don't punish them for this reason. But once you are caught doing something else, you don't want to further deteriorate your position by being caught discriminating, and so you start to behave a little bit better. Now, you may say, okay, you're nitpicking, because what is the difference from their catering hypothesis to my regulator sleep hypothesis? And in fact, there is one big difference, is the efficiency and the implications of the results. Now, the authors go some way in the direction of actually discriminating between the two hypotheses by looking at subsequent default rates. In fact, they look at the riskiness of the various portfolio, and they find that the default rates are not higher. So in the regulator seems that is consistent with regulator failing their job to begin with. However, a lot of things are going on at the same time. So my suggestion is trying to go at minority loans specifically, not if you can, not look at all your non-performing assets, because too many things are going on at the same time, including the fact you lend less on average. So might be that you're taking much more risk in minority lending and much less in other, and the two compensate. So I want to be very clear here, because this is, to me, is the most important aspect of the paper. If you are in a world in which before the EDO event, you are under-lending to minorities, you should have a much better performance in terms of default before, and that is reduced afterward. If you are catering to the regulator, you should have a equal performance before that gets worse afterward. And I think that that's something important to find out. Now, Anya and Corto are already addressing a bit about how special the sample is, because it's only composed of EDO banks, banks that were subject to regulator. Now, these are banks that are small. That's the reason why Abacus Federal Savings came to mind. Now, one question that maybe is outside of this paper, but I think is very important, and I would like to have an answer to this, is why only small banks get reprimanded? Is because only the small banks have problems, or because the big banks are too powerful to be disciplined, and so you get angry with the small ones because you can? And if the latter hypothesis is right, are we really sure that all these ADOS enforcement are correct? Or maybe they're just a way for the regulators to show that they're doing something, because they are not going after the real problems which are in the big banks. So they want to show that they have some action. And so they pick on the small guys like Abacus, even when there is not enough evidence to lead to a serious conviction. And I think that, of course, this would be a very different interpretation depending on the cases. Now, even if all this enforcement were legitimate, isn't this a bit of a sample of screwed up banks? And not necessarily that they control for the environment, but that's not, in my view, the problem. The problem is, if you're thinking that these are really bad banks, the bad banks in every dimension, so how much you can extrapolate on that. Now, even in the interest of minority lending, our representative is the sample, and our important is the life of the minorities. Now, Abacus Federal Savings was really vital for the Chinese Americans in New York City and New Jersey. Is any of these banks really important here? Final minor point. There is not really a distinction here between minorities and underrepresented minority. And I think that my presumption, and I might be completely wrong here, but my presumption is that if you isolate the Asian American, they might be less discriminated to begin with. And so by mixing them, you're actually underestimating the true results. So I think it would be interesting to separate the various minorities and see how big an impact that. Now, what caused the drop in loans? And the authors attribute this drop to the drop in deposits due to reputational consideration. I've not read the other paper, but which deposit dropped? Because it's very hard to imagine that uninsured depositors should care. So if they do, they care for morality reasons, not for economic reasons, because they're completely insured. So, and are uninsured deposit for this bank big enough? And if you look at the drop in loans, is much larger than the drop in deposits. So my guess is that there is some form of distraction effect, like in the Abacus case, mortgages were stopped, part because it's a small bank and the entire bank was fighting the accusation in court, and they didn't have time to do anything else but prepare the cases. So it would be interesting to know what is the real effect. Now, I think this is a super interesting topic, and the results of this paper are really intriguing. In my view, the authors should focus more the analysis on the welfare consequences. And if they do find that other banks inefficiently discriminate before the disciplinary action is going on, this can be a very, very impactful paper, because we'll be saying that the regulator are asleep. And if that's the case, I would like you to retitle the paper, The Sleeping Regulators, and then distinguish who is more asleep, the Fed or the state regulators. Thank you.
That was fantastic and definitely deserved a response from Anya. So please comment on Luigi.
Thank you, Luigi. I expected nothing less. I'll just respond to a few comments, in particular, kind of why are these banks smaller? So I think one important issue here is that these are community banks. They're so smaller banks, and the way they're going to be regulated is going to be very different than large banks that you have in mind. So say smaller banks would have supervisory team do the examinations every year, every 18 months, while the large banks would have the supervisory teams on site all the time. So these are banks that have regular exams, and it's the supervisory exam that identifies issues with the bank, and the examiner team proposes whether the bank should receive enforcement action or not. In particular, because their composite CAMELS ratings fall below a certain threshold. So a bank with a CAMELS rating of 4 or 5 in any of its components is going to have a recommendation from the examination team to their supervisory team to then either the FDIC or the Fed or the OCC, depending who the supervisor is, to issue an enforcement action because there's certain violations. We can take it further. And we can see we using non-public data. We will try to investigate whether there's something there. But this is the reason why you see enforcement actions probably being issued to smaller banks more than to larger banks, because the supervisory mechanism for larger banks has other tools that are being actively used as well. In terms of, I think the point that you're making about whether the regulators are asleep, we can do more about kind of whether there are some other ways of identifying enforcement actions that might be dealing with violations of fair lending laws. We are focusing on severe enforcement actions, so that they require banks to stop doing something that happened at the end of the negotiation process between the supervisory team and the bank. So it is possible that there are less severe enforcement actions that cite violations of fair lending laws that we're just excluding from our sample because we wanted to look at banks that really have to do certain things. And our project started from the fact that we wanted to understand what banks do during the life cycle of enforcement action. And we actually were very surprised to see that we are documenting that they changed the way they lend. And part of it could be because they clean up their act, because they now have attention on how they lend from the regulator specifically. And so that could be part of the process, that by improving their lending processes, they might be lending more to borrowers that before couldn't access loans, because we don't show that these are borrowers that then default on loans. And to your point about doing more about the performance, we are looking into other data sets that we can combine with our data just to see whether we can observe the performance of those loans over time. But yeah, we're happy to follow up with you afterwards on those comments. So thank you.
No, but seriously, I understand the origin of the paper, but I think that you stumble on something very important, and I'm not so sure your current employer is delighted if you continue in that direction. But I think that society will be very thankful if you continue in that direction, because try to figure out that these laws are not enforced. That would be quite interesting.
Well, These are all my views and not the views of my employer. But I will definitely want to explore this, but because I agree, it is puzzling that we don't see more enforcement actions that are due to violations of fair laws. And this is something that we're investigating to see whether there are other mechanisms that are enforcing fair lending, because the regulators are charged to enforce the fair lending laws. So we can look at that, as well as maybe look at the later period when we actually have a regulator specifically created for this purpose, which is CFPB with the Dodd-Frank Act. So that's maybe something also to look at that we can definitely consider. Thank you.
There was a point in Luigi's discussion that I also came up in the questions, which was, do you have the ability to look across different types of minorities? And have you looked at that at all? Do you have any insights to share with us?
We do. We can look across different minorities, and we have done, and I should have mentioned it when I was presenting the results, and it probably also needs to be clearly mentioned in the paper, that we did look at specifically African Americans as borrowers, and we find stronger results for that community. So maybe that goes to the point that Luigi was making. If we really want it to be about discrimination, we should look more into those borrowers, and not just all minorities. Another thing that we are currently investigating is looking at the areas that were subject to redlining, because kind of one of the hypotheses that we have is that in areas where there was historical redlining, community banks might have more incentives to cater if they're lending to minorities in those areas that have been in the past disadvantaged significantly and were subject to those discriminatory policies. So that's another way of maybe thinking about it as well.
You also have this result that it's not through new loans, it's through individuals who the banks are already familiar with. Could you talk about that result in the context of statistical discrimination? So these are already individuals the bank might have more information about. So why do you think that that's the lending that's being impacted?
That's a good question. We can't say unless we have more information about those borrowers, which we are trying to get to, whether these borrowers were statistically discriminated or taste-based discriminated before, because we don't have borrower characteristics. One thing that the HMDA data does not provide to us until 2018, which is after our sample ends, is the underlying borrower characteristics. But we are trying to merge it with other data sets to be able to provide those insights about whether the quality of the borrowers changes for that result or not, because it would be a different outcome if it's all based on the same kind of borrowers now more likely to get loans because they have history, or borrowers across the board just not getting with different characteristics are getting kind of risky. So it goes back to Luigi's point: are they lending to riskier borrowers, or are they lending to the same type of borrowers? They were good applicants, they just got discriminated because because of who they were. So maybe that will get us to taste-based versus statistical discrimination once we can merge those characteristics about the borrowers, as well as sort of an exposed tests of the performance of those loans for a subsample of borrowers that could be matched.
And I'm going to re-up one of the questions from the discussion, which was related to the actual impact on people's lives. So if you find that there's some statistically different change, before and after an enforcement, is that a drop in the bucket? Is this a big deal? This is just for community banks or small banks. What does that look like within the big picture?
So for those banks, it's a significant change in terms of the market shares they now have in those markets and how much of their portfolio they allocate residential mortgages where they lend to minorities. We also see that because they expand to where they lend, it means that they are reaching a wider pool of borrowers. But you want the actual magnitude. So we don't have that in the paper, and we can definitely try to quantify it. And again, Luigi said sort of he would like to see more on welfare. So we can think about the welfare implications more directly rather than sort of interpreting the result as they are for their sample. But it will be still caveated by the fact these are community banks, they're smaller, so the impact is going to be in certain communities. But maybe by looking at the particular disadvantaged areas, we'll be able to say a little bit more about what is the magnitude of the benefit that we're now seeing as a result of banks lending more to minority borrowers.
Okay, I think that's all of the questions that we have, unless you have any more comments that you'd like to share. Or if you have any more comments, Luigi, no?
No, thank you.
Okay, perfect. So I guess we can wrap it up here, and next we're going to hand it off to Neil Kashkari, the president of the Minneapolis Fed.
Thank you, Amanda. Appreciate that. Thank you to the great discussion we just heard from. I want to thank everybody for joining. This was a terrific, wide-ranging event, just as Abby promised it would be. Let me just offer you a couple of key takeaways from me. One of the things I like about this conference is it was very focused on topics that are front and center, top of mind for us at the Fed that we're wrestling with on a day-to-day basis. And I'll just focus on one, which is this debate about, is monetary policy or easy monetary policy, does it disproportionately help the asset holders? What about low income workers who may not have many assets, and that differentiation? You know, I hear this a lot. I usually hear from two groups. One group are kind of hysterics on Twitter who love to tell us how they're, you know, advocating for the poor. And then from millionaires and billionaires on Wall Street who also say, hey, the Fed should just tighten monetary policy to try to rein in financial markets. When I talk to my friends who work on Wall Street, what they're really saying, if they confess to me, is they want to get asset prices down so that they can go put some capital to work. But of course, they try to wrap it as though they're advocating on behalf of the poor. Well, the way I think about it is, you know, for a lot of low-income folks, they don't own stocks, they don't own a home. The most valuable asset they have is their job. And I appreciate that some of the papers today try to get at that perspective. And what do I mean by that? It's not just a soundbite. Think about a job that pays $30,000 a year in annual income, not a high-paying job. What's the equivalent asset? Well, in a 10% interest rate environment, that's a $300,000 asset. But we're not in a 10% interest rate environment. In a 1% interest rate environment, that's a $3 million asset. And so it turns out that jobs are enormously valuable, and that I, for one, and I think many of my colleagues at the Fed, are trying to use monetary policy to strengthen the job market, to help get wages going up, especially for the lowest income Americans. And we saw that in the last years before the COVID crisis hit. We saw the fastest wage growth for the lowest income Americans, and we saw people getting jobs when we thought we were out of workers, yet more and more workers magically appeared. And so that's a tremendous benefit. And I appreciate the fact that the research today was trying to get at that. And one other sanity check for me, you know, people kind of know what's in their own interest. And when I go out and I meet with low income communities, I've never once heard somebody say to me, boy, would you please raise interest rates so that we can keep these other people over here down? No. And some people will say, well, these folks are not that sophisticated. They don't really understand how monetary policy works. I don't necessarily agree with that, but I hear that from market commentators. But I've never once heard from a member of Congress who represents a low-income community who says, would you please raise interest rates to clamp down on these people over here who are enjoying success? Because they recognize that it's their own constituents that they are advocating on behalf of. They want them to find jobs and they want them to enjoy higher wages. And so to say that, well, we're going to clamp down over here on these people, but who's going to pay the price? Well, these disadvantaged people over here, that strikes me as a lousy trade-off. And so I really appreciate the fact that the research today, the papers today, we're trying to get at some of these dynamics, which I think are really important. And again, for me, the sanity check always is when I go into communities, what am I hearing from people who are in those communities? And they're saying, help us find work, help us enjoy higher wages and more job opportunities. And that is front and center for me. This institute was built to try to connect serious research to important policy questions. And I think today's conference is a great example of that. That means sometimes letting research take the lead, as it did today, sometimes taking time to hear from policymakers or from the community that we are actually working on behalf of. And so we are going to have conferences that have a research lead, some that have policymaker lead, some that have more of a community focus, and we hope that you will join us for all of those. Last thing I just want to say is thank you. Thank you to so many people who helped make today a success. The programming committee included the moderators and the hosts, the speakers and the discussants who clearly put a lot of time and a lot of thought into their remarks today, the audience for joining and posing good questions, and all the folks behind the scenes who helped pull this off. And so I want to thank you for joining us. Hope you have a great rest of your 2021, and we look forward to seeing you again in 2022. Good night.